Hello, everybody. This is going to be a long one, so make sure you got some food and drink. In this video, the main goal is to get all of the strat concepts taught in the same place. So we're going to start literally from the beginning. What is the strat? Why? And then the how, the three universal truths, and how we combine those together. So we're going to go over how to draw the broadening formations, how to find trades, the signals, all of that stuff, as well as risk management. So it's gonna be a little bit longer here, and let's get started. So I'm gonna act as if you know pretty much nothing about the stock market. So the first thing is, what is the stock market? Well, it's obviously a place where people go to buy and sell. And we're gonna keep this really simple. I'm just gonna use some MS Paint so we have something to follow along with. So you're gonna have buyers and you're gonna have sellers. One of the main things people believe that is false is that you can have more buyers than sellers. Let me show you why that's wrong. So you can think of the stock market similar to like a car lot. And before we keep going, I'll get my video up in here. But you can think of it like a car lot. So you're going to have a buyer and a seller. So in this case, the seller is going to be the person selling the car. And then the buyer is going to be whoever walks onto the lot and wants to buy the car. So in order for a transaction to go through, the seller and the buyer have to come together and they have to meet at a certain price. And if they agree on that price, then from that, you're going to get a transaction. They either bought or sold the car at a specific price. So in the same way, a stock market's going to function the exact same. They have different words for it though. So a seller would be considered the offer. And then the buyer, they will call it the bid. So we have an offer and we have a bid. And these are what we're always going to be referencing to when we talk about stock data. It's always the bid and offer and the buyers and sellers on those bids and on those offers coming together and creating transactions. So when we look at a stock chart, what we're actually looking at is a summation or a bringing together of all the transactions based on a time frame. So in this case, you can see up in here, and we'll zoom in a little bit. Try my best. So you can see we have a daily time frame. We call this an aggregation. So what that means is that each one of these bars, it's gonna be one day. And what that then tells us is these bars are representing all of the transactions within one trading day. So within that day, every buy and sell order gives us this candlestick and each one of these candlesticks. So when we look at a candlestick chart, we're just looking at all the orders that occurred within a certain time frame. And that's important because you need to know what the data is that you're looking at, right? Now, as far as how these transactions occur, there's two major ways they're going to happen. So you have the seller and you have a buyer. So we call them bid and offer. So what happens is the offer or the seller, they always want to sell at a higher price, and the buyers always want to buy at a lower price. Like, never do you walk into the car lot and they're like, yeah, we want $40,000 for this car right now. And you're like, yep, shake hands and leave. Rarely does that happen. A lot of the time, you're going to walk in and you're going to lowball them. You want to get it at a lower price. So what's going to happen is you'll have a spread. So between the buyer and seller, the seller is going to come in at a certain price. The buyer is going to come in at a certain price. We'll say it looks like this. Everything in between, this is called the spread. So when we're looking at transactional data, we want to look for aggressive buying and selling that's going on, because that's what actually moves the stock market. So what that looks like is, let's say the buyers, they want to buy at 100. The sellers want to sell at 101. The market wouldn't go anywhere if the buyer's trying to buy here and the seller's trying to sell here. It would go sideways indefinitely if this is what it looked like. Now, in order for the market to go up, what needs to happen is this buyer or a new buyer needs to come in and be willing to pay up and cross the spread and be like, yeah, you know what, seller, you want it at 101. I'm willing to buy it at that. I'll buy 1 million shares at that price, right? And then the stock will go up. So this would be what we call taking the offer. The buyers take the offer, and this would be what causes prices to go higher. We can also have it where the seller, if they're more aggressive, they will hit the bid. So they're going to cross the spread Instead of trying to sell at 101, they're going to say, yep, $100. I want out. I'm going to sell you all my stuff at $100. And this is what causes stocks to go up and down. So when we look at a candlestick chart, before we dive too much into those guys, the green and red tells us which one of those is happening. So you can see when you have a long green bar, what's happening? Well, they're buying and they're taking the offer today. Most of the orders were buy orders, and they were aggressively taking the offer, which causes prices to go higher. You can see the bright red bars in here. This tells us they're selling and they're hitting the bid, and they're doing it aggressively, so prices go lower. So when we look at a chart, that's what it's showing you. It's showing you transactions going through, and it tells you, based on the color, who's more aggressive, buyers or sellers. Now, as far as what a candlestick's going to show you, it's going to have an open, a close, a high, and a low. And I don't have my graphic up, so forgive me. I'm going to pull it up here. This is coming straight out of the boot camp, and we've got a lot of content in here. If we dive into the introduction here, we can see, so for a green candle, it's going to open lower and it's going to close higher. So what you'll see is it will open. And this is the level it opens at, the bottom of this rectangle. And we call that a candle body. The low is going to be this wick at the bottom. And then the high is going to be this wick at the top. And then the close is the top of that candle body. So you can see it opens lower and closes higher, which is why it's green. The same thing is true for red candles. So for a red bar, you see it opens higher and closes lower. So it's going to open at a certain level. Then it's going to make a high. You see the wick, the top of this wick. Then it's going to make a low, the bottom of this wick. Then it's going to close out right here at the bottom of this rectangle. So what we call these wicks, and we call this the candle body. Some people will call these wicks a shadow. I'm always going to call it a wick. But when we look at price data, this is what your charts can be built up from. It's going to be a ton of candlesticks. Anything else really we don't believe is useful. Now, the aggressiveness of that buyer and seller is dependent on how green or red it is. So when we look back here, we can obviously identify aggressive buying, aggressive selling in here. The opposite of is true when you have this very small body. Notice it's not very green at all. It closed 5 cents higher than it opened. Pretty much went nowhere. Not very aggressive, right? That's what that would tell us. So when we're trading, we prefer nice long and red and green bars because it shows aggressiveness. Now, since we understand a little bit of the data, a little bit of the candlesticks, let's dive into the strat. What is the strat actually? A lot of people say the strat is a trading strategy, and that's partially true. What I would tell you it is a way of identifying the data the same way, a data scientist is going to have to quantify a ton of data, which just means like you're gonna have to know what it's telling you. Because if I give you a chart, and everyone, in math class when they're younger, if I give you a chart and I have an X and Y axis on it, but I don't tell you what any of the data is, it's like, well, you have 5 what? Is it $5? Is it 5 monkeys? Is it 5? We don't know. So when we talk about the strat, it's a tool that allows us to know exactly what we're looking at. And that's going to remove any subjectivity from your trading. And that was the whole goal of the strat when it was built. Remove subjectivity, make it objective. And therefore, when we plan our trades or create our trade plans, the plans are going to be executable because we know what we're looking at and what we're looking for. They're going to be consistent because we're always looking for the same conditions and price. And they're going to be true because we're basing our analysis for our trades on what we can know to be true about price action. And if you want to learn more about the guy who made it, his name was Rob Smith, and you can Google Rob Smith the Strat or Rob Smith the Strat LinkedIn, and he has a whole thing he goes through. That's similar to this. That being said, what are the 3 universal truths? That's where we're going to start next. So the first universal truth is from one bar to the next, there's only 3 scenarios that can occur. And I want to pull up my little diagram here so we have something to look at. So what this means is that when you look at candlesticks, just looking at the high and low of the candlestick, ignoring what the body looks like, so just the wicks, there's only 3 scenarios that can occur. So you literally can only go sideways, up or down, or a special scenario over here. So everyone likes to like make a post and they're like, well, the stock might do like, it might go up, it might go sideways, it might go down, but they're actually missing one, which is the funny part. So the three scenarios are this. The scenario one is an inside bar. So what we'll notice is this high and this low is within the previous bar's range. So when this occurs, yeah, exactly. But when this occurs, we are stuck in the middle of the range, and that is considered a consolidation because price action is getting smaller. It's making lower highs and higher lows. What that tells us is buyers and sellers agree on the price right now because it's not going anywhere. You can see it's red. So you could say, hey, the sellers are more aggressive since it's red, but it's an inside bar, right? It's not making new lows, not making new highs. It's going nowhere. So scenario one is sideways, right? We don't want to trade this. We also have scenario two, and scenario two is directional, which means it's going to have a higher low and a higher high. That would be considered two up. It's making higher lows and higher highs. That's an uptrend for sure. Or you can have a two down. You're going to see it's lower highs and lower lows to the previous bar's range. Therefore, it has to be going down. And that's something I'll add in. When we talk about scenarios, it's always in relationship to the previous bar. Hopefully that's clear. Now we also have the scenario three, which is a special one because not many people understand it. Even if they're trading and they don't trade the strat, they'll see it, but they don't quite understand what's happening. The scenario three is an outside bar. So it makes new lows and new highs. Whereas the scenario two only makes new lows or new highs, only one at a time. And the scenario one does neither of those things. So this will make new lows and new highs and take both sides of the previous bar's range. And therefore, we can also deduce, or we can expect, you cannot have a three without a scenario two first. So for example, if we take any of these twos down or twos up, if I just drag on this, it won't change color, but it must take out this previous bar's lows and then change from red to green and go the other way. So if I change this color here, which I don't know if it's going to let me. Yeah, it's probably not. We'll do it over here. But you can see, so in order for this three to happen, it has to make a new low and a new high. So it's going to have to make the new low first and then make the new high. The same way a three to the downside. It's got to start as a two to the upside first, like this, and then go scenario three. So this tells us how to gauge magnitude of where price is going. And before I forget, just want to fix that here. Perfect. And what I mean by magnitude is like, if we take out a low and then we change the color here, so we're a two down, but we're green trying to go the other way, we're going to expect the scenario three to occur. Because if you have a two down in green, it's attempting to go three. If you have a two up that's red, it's attempting to go three to the downside. So in the chat, let me know, is anyone confused with this? Because this is very, very important to what we're going to talk about all day here. And if you're good, just throw like a thumbs up in the chat so we can keep going. Just need a few of you guys to throw them in there. All right, we're good. All right, perfect. Thank you. Okay, so that's the first universal truth of three. And it looks like we do have one question. So you expect it to go three in one bar, or it can take multiple bars. It can take multiple bars, and we're about to talk about that shortly. So all good. So the second universal truth is this. Since we know there's only three scenarios, we're going to look not at just one chart like most traders do. What we want to do is we want to look at 4 or more timeframes, because the second universal truth tells us this. Price must trade in the direction of the most scenario twos. So two up or two down, and twos that are becoming three or attempting to become three across 4 or more timeframes. So in this example, we can go through and it'll make more sense. This sentence was super hard for me to understand when I first started. But we can start at the biggest time frame, the month. We commonly use the month, week, day, and 60. So when we look at the month, it's a two down, but it's green. And for this example, we'll say it's still open. Let's say we're like 10 days into the month. We still have 20 days to go. So this is a potential 3. So we know it's trying to go and take out the black line right up in here. Then when we go to the week, it's also 2 to the upside this week. So we have a 2 going 3 month, which gives us a target. We have a 2 on the week in the same direction of the month, and they're both green. Then we go to the day. We have a 2 to the upside on the day. Then we go to the 60. We have a 2 to the upside on the 60. So at this point, it's going up on a 60-minute basis. It's going up today. It's going up this week. It's going up this month. So what does that tell us? Well, if it's going up this month, this week, today, and right now, they're buying. It has to be going up at that point. The only thing a trader could say is it might turn around. But at this point, it definitively is going higher. So this is what it looks like when something's definitively going higher. And we talk about this in reference to the open. So for above the month, week, day, and 60 opens, we would say we have a period of full time frame continuity where every single time frame is a buyer and they're taking the offer and it's going up. And that's a good thing to know. And the reason that's a good thing to know is because what this allows us to do is pick up on algorithmic buying and selling. And just so I can show you here, we can just go to Google and we can ask Google, how much of trading is done algorithmically? So in the US stock market, algorithmic trading is estimated to account for 60 to 70% of total trading volume, which means 60 to 70% of the transactions going through are automated and they're done by algorithms. And some estimates could be as high as 80%, which is not surprising at all. It's slowly moving towards everything being automated, right? So if most of the trades and transactions going through are done by algorithms, the first thing is you've got to forget about what everyone else said or has said. They're going to say the algorithms are taking your stops. The algorithms are doing this and doing that, causing you to lose money. But that's actually not true. The algorithms are simply buying or selling positions. And just to give you a picture, so imagine you're Goldman Sachs and you buy and sell equities. If you have a trade desk, that trade desk executes the trades. You're also going to have people that do analysis, right? Or you could say like Warren Buffett. It could be anyone. Now, you do the analysis. It could be technical. It could be fundamental. It doesn't matter. And then that analysis gets sent to the trade desk and they're like, hey, we think we should allocate a lot of our money into this stock or this sector of stocks because of this, and this. Then the trade desk goes, okay, well, I've got to go fill that order. So I'm going to log in. I'm going to tell my algorithms to go and fill this order. We need to buy, 50 million shares of Coca-Cola, and we need to buy 100 million shares of Apple. So what happens is they go and tell the algorithm, hey, we need you to buy, Apple, for example. We need you to do it aggressively. You're going to buy and you're going to take the offer, which is the most aggressive way to get into a position because we really want the stock. We want to have the investment. And then you're going to do it at a certain time. So you have to tell it, what is it going to trade? Like Apple, SPY, whatever it is. Is it going to buy or sell? How is it going to buy or sell? By taking the offer, by hitting the bid, by sitting on the offer, by sitting on the bid, and then when to do it. So if it has to be told these 4 things, when we look at a chart, what we're actually looking at, since most of it's algorithmic trading, is if we pull one up, what we're looking at, especially when we have 4 time frames up, is we're looking at where are those institutions buying and selling at any point in time. So like if we go to SPY, we go to the monthly chart. This month, it's red. So what are those algorithms being told to do this month? They're being told, sell. You're going to sell SPY. You're going to do it by hitting the bid below this monthly open where the sellers are more aggressive. And you're going to do it this month. And then when we look at the week, you're going to do it this week, which was last week's open. And this week as well. And we go to the day. Anytime the day is red, they're doing it that day. So you can see yesterday got after it a good bit, and then today not so much. And then anytime the 60 minutes red in there, that algorithmic selling is going on. So what we're going to see happen is since the month is red, they're going to sell it down. Then there's going to be profit taking or poorly timed long positions, and then they're going to sell it down. And there's going to be profit taking or poorly timed long positions, and then they're going to sell it down. And it's going to keep doing this because price must trade in the direction of time frame continuity. And we're going to talk more about it. But what I want you to think about is the fact that when you pull up these charts, you're looking at, if it's red, right, they're selling this month. And that's something we want to know. So hopefully that makes sense. If you have any questions, we can also take questions here just so we understand. Had a major seller hit that button today at 10:03. Yeah. It's definitely been some decent trading. Looks like my stream settings, we might have a little delay going on. No, it's ultra low. Yeah. But if we're good, just again, throw a thumbs up in the chat. Let me know. We don't want to leave anybody behind on this one. Good. All right. And remember, it's like, this is like the introductory stuff. We still have a lot more to dive into. We're just trying to keep it nice and simple so we all understand. Perfect. All right. If you have any questions, we'll come back to it, but throw those in the chat. All right. So we now understand price trades in 1s, 2s, and 3s because they're either going sideways, nowhere, up, down, or you fail the downside, go to the upside for a 3. Fail the upside, go to the downside for a 3. We also know price must trade in the direction of the most scenario 2s and failed 2s going 3. The third universal truth is that the broadening formation is how price discovery works. And what this means is this. We're going to pull up our little doodle in here like so. So the broadening formation can be identified because the outside bar exists, which makes it a universal truth of how price works. Because if price only trades in 3 scenarios, one of those scenarios is it's going sideways, and another one of those scenarios is that it makes a broadening formation by going an outside bar. We want to know what a broadening formation is. It's one of the 3 things price does. So what this tells us is if price takes one side of the range and fails, it's attempting to take the other side. And this allows us to gauge the magnitude of price moves. So we're going to talk shortly about signals, but the broadening formation is what allows us to gauge how far price is going. So for example, since we know the scenario 3 is a broadening formation, let's take a look at what SPY did the past 2 months because you'll see it. So we had a 3 in here. And if it's not clear enough, because the wicks aren't that big, you're going to see this. So we have a 3. That's a broadening formation. What that means is it made new highs to the previous bar and new lows. And since broadening formations are defined as a series or repeating new highs, new lows, new highs, new lows, we can expect that to occur. So you're going to see new highs and new lows. And then last month made new highs, and then it failed, starts coming the other way, and then makes new lows. You can see the sellers came and started here, 596.32 this month, and they took out the lows. So if we go to a lower time frame, you're going to see this even clearer. It's like a daily chart. You're going to see it starts small in here, new lows and new highs. Then it gets bigger, new highs, new lows. You can see it grows in size. Then we make new lows, it's bigger, new highs. Then we make new highs again, fail, coming the other way, and then you'll see we make the new lows. And at this point, it's still getting bigger. It's expanding. So when we look at the market, what we want to do is we want to trade signals, which we'll talk about shortly. And we want to time them from one side of the broadening formation to the other side. And we want to do it ideally with full time frame continuity, where we have the algorithmic trading on our side. Because if we do that, we're going to be entering on signals that should really just start going right away. And then we're going to be doing it with the algorithms who are taking the market in a certain direction. And we are able to gauge where it's going. Because we know if a trade works, it's going to take out the other side of the range. So for example, we can see on the weekend here, they started selling here Tuesday, it was mid-February. And then we had a 2 down in here, end of February. Beginning of March, we went 2 down again. Then second week of March, we're still 2 down. So they've been selling since right in here when this went right off the highs. Therefore, it's like when this selling started occurring, we're going to expect to take the other side of that outside bar on the monthly chart. And I know this is a lot, so we're going to get into signals and reversals and stuff. I just want you to understand how those are all going to work together. Because if you can kind of have the idea of like, okay, well, we identify who's more aggressive, the buyers or sellers with the algorithms. And then we know it's going in one direction via that time frame continuity. And then we know the broadening formation tells us where that time frame continuity is going. The last piece of it is how do I get in the trade? How do I manage the trade, which we'll talk about shortly. So we'll talk shortly about more in depth into the time frame continuity. Does broadening formations only go from the 3 candle directly behind it? It could be outside of multiple bars. So like, let me just show you an example of that. So you'll see this is a 3 on the week. This 3 is outside, not just of this previous bar, but it's outside of these 3 bars. So you see this bar outside of all 3 of these. And we're going to talk more about the 3 shortly. I just wanted to give the little intro here. It just makes sense objectively. Yeah, it's great. It's nuts once you start seeing it. All right. And hopefully everyone after this sees it. That's the goal. All right. Now that we have a little intro into the 3 universal truths, we're going to start back to the first universal truth. And we're going to talk about what the first universal truth then gives us. Because we have our major premises, right? First universal truth, there's 3 scenarios. Now, all the other universal truths are derived from the 3 scenarios. So, what can we derive from the first universal truth? We can derive the fact that there's a limited amount of reversals and continuations that can occur. So we will always know what a reversal looks like. We'll always know what a continuation looks like. So for example, these are going to be the most common reversals you'll see. And we call them inside bar reversals and 2-2 reversals. So an inside bar reversal is going to be, it could be a 3 or a 2, but it's going to be a nice red bar followed by an inside bar. And then every inside bar also must be followed by a 2. So you can see it goes inside bar and then 2 to the upside. So we would have, in this case, we would say 2 down. This bar was a 2 down, a 1, and then a 2 up. So that is a 2 down, 1, 2 up, and that's a reversal. So we can say that's a 2-1-2 reversal to the upside. And the way we play this, we'll talk more about risk management shortly, more towards the end of this video. But we would want to buy the break of the black line. The stop, we'd want to put it at the low of this bar. And we're going to target the green bar. And you'll say, Alex, that's a really small target. I promise you're going to see how these get really big in the near future here. But we can have 2-1-2s to the upside. We can have 2-1-2s to the downside. There is also 3-1-2s, which are similar, but they show more aggression. And the reason is because the scenario 3 is a broadening formation. So you can see they tried to buy it up. Then the broadening formation, we get that failed 2 going 3. They sold it down. Then they go inside. And then they choose a direction. In this case, to the upside, and that's a reversal, 3-1-2 reversal to the upside. We can also have the 3 to the upside. So you can see they tried to sell it down, the sellers, and then the buyers came and aggressively bought it up. Then they go inside bar, doing nothing. And then they pick a direction. They become scenario 2. They go reversal. You'll see the green line is always going to be our target. The black line is always the break of the actionable signal. Good to see. Now, when it comes to signals, we reference signals based on are they in force or not. So if the bar is still open and the bar is trading below this black line, we consider that a signal in force. And we would say, as long as we're below that, we have a magnitude or target to take out this green line. We want 1 penny below this green line. And that's going to be true for every signal. So you can see a 2-1-2 reversal is going to be the same thing. And as we zoom out, they're all going to be very similar besides the 1 bar rev strats, which we'll talk about shortly. The second most common reversal that is going to occur in the market is what we call a 2-2 reversal. So you're going to see we have a bullish variation and a bearish variation. In this case, you're going to see we have a 2 down. That is green. So it's closer to a 2 up on the next bar, which is always important. What is the next 2? We'll talk about that shortly. But you'll see we have a 2 down, followed by a 2 to the upside above this black line. And then the same thing as like we said before. Anytime this breaks and it's above this black line, we want to be long and we have an expectation to take this green line out. And the reason that is because we know the outside bar occurs. You're going to look at this and you're going to say, Alex, we have no outside bar here. But that's patently false. The reason that is because when a 2-2 reversal occurs, it is causing a compound outside bar, where if you put these bars together, that is a scenario 3. And this is the trick to understanding broadening formations. So at any chart you look at, you compound the 2s together, you're going to see where the 3 is. So in this case, that 2-2 reversal made a compound outside bar where these 2 bars go outside of this bar. And with every 2-2 reversal, that's always what we're looking to do. You can see the 2 up, 2 down reversal. It's going to be the same thing. We have a 2 to the upside. Then it breaks 2 down below this black line. It's in force. Then we take out this green line. And these 2 bars go outside bar to this bar here, where you're going to see the compound 3, where you compound them together, and that is definitively a scenario 3, which definitely means it's a broadening formation. And that's good to know. Move this back. Now we have also 3-2-2s. So the 3-2-2 is awesome because it's a broadening formation, which shows aggression, the scenario 3, and it's a 2-2 reversal. So it's 2 things we love to know about. You see they bought it up, making new highs, and then failed, made the new lows. So they tried to buy it, sellers came in, took out both sides of the range. Then they tried to sell it down again, but the buyers came back. And you had a 2-2 reversal, which means these 2 bars go outside of this outside bar. So this would be what you'd see as a 3-3. Broadening formation, broadening formation. And what we like to say is, once you have a 3, that's always a broadening formation. So if they did it once, you can see it goes up, new highs and new lows. They might do it again, new lows and new highs. And they might even do it again. We've seen, if we go to Dow Jones quick, just to show you. We go on Dow Jones, you can see this happens all the time. You're going to see 3, and then it's new lows, new highs, 3. New highs, red, where's that going? 3. Right, and then at this point, you can see they stayed out of that 3. They failed to get back into it. They tried, and back down, and they expand it, getting bigger, which we'll talk more about shortly. But just understanding 3, 3, 3, it will repeat. And before we continue, is there any questions? Let me double check. So as soon as it triggers, do you enter or do you wait for a close on a lower time frame and then enter? We enter at the break. And we'll talk more about that. It depends on the time frame you're trading and how you're going to want to manage your risk. And that's going to be more towards the end of the video. So just hold off on it. If you watch like the first half of this, you don't get to the end of the video, you're not going to know how we manage risk. And I think it's the holy grail of how you're actually going to make yourself a winning trader if you do it like we will teach towards the end. So does enforce just means it crosses the entry mark? Yes, but it has to be open. So for example, and I actually do have some stuff just specifically on this. So we call it exhaustion by time. So for example, you're going to see we have a 2 down, 2 up reversal. This is only considered in force if this bar is open and above the break of the signal. Once that bar has closed out, it is no longer in force. You can say it's, still closer to continuing to the upside, which you can see in this case it would, but it's not considered in force anymore. So you only have the length of the time frame that the signal sets up on. So for example, we go to AT&T. When we look at this 2-2 reversal, 2 down, 2 up, you'll see it's 3, 2, 2. You have this whole day to go after it. Then once it closes out, that is no longer in force. So it needs to continue by making new highs and going 2 up again. And then you'll see it goes 2 up again. And then in this case, we had a gap down. They take them all out. See 2-2 reversal against. So you must stay in force and it must still be open. All right, looks like we're good. So let's get back to the reversals here. So the next thing we're going to see is what we call the rev strats. And these are good because it's going to tell you about something specific in the price data that we want to know about. And this is what if you've traded ICT, every ICT trader is only trading rev strats. They just don't know it. So what a rev strat is a reversal after an equilibrium or after an inside bar. Those words can be used interchangeably. But what must happen is you must close an inside bar, which makes it an equilibrium where buyers and sellers agree on price. Then you need to see a reversal occur after the inside bar has closed out. So the most obvious one you're going to see here, you see the inside bar closes out. Then they try to take it down. So there was sellers in here hitting the bid. It was going lower. But then a buyer shows up and brings it right back into this inside bar. This is the rev strat, the 1, 2 down, 2 up reversal. So you see, we're pairing the 2-2 reversal with an inside bar. And the reason it's called a rev strat is because it's a reversal strategy. And it's a reversal of momentum. So when this goes inside and down, momentum, you could say, which I don't like that word, but it's momentum to the downside. When this goes 2-2 reversal up, it went from momentum to the downside to now a momentum to the upside. So what's happening is you're countering really aggressive sellers with more aggressive buyers when this occurs. And the reason we know that is because the rejection is always stronger than the initial move. And it's like, how do we know that, Alex? It's like, well, imagine this. We have the bid and ask. We already understand that. So hopefully you don't have to keep that here. But what's happening is this. You'll have that equilibrium form. You could think of it kind of like a pool. So the buyers and sellers, let's just say the offer is up in here and the bid is down in here. They're just going back and forth, right? They're not actually moving price because it's not making new highs, not making new lows. It's going to be sideways in here, doing nothing. Then what happens is it will try and break one side of the range. And since we know broadening formations occur, if that break fails, it'll take the other side. So in this case, let's just say it's like this. Then the new bar opens. What happens is you now have this seller that comes in and hits the bid. So they're aggressively selling this down. And therefore, it went from, hey, buyers and sellers agree on price to, hey, we have a new seller that entered the market. Then what happens is there's either profit taking or there's going to be buyers showing up in here that bring it back into this range. So what happened is there was an aggressive seller, and now we have a more aggressive buyer countering that seller. So if you shorted or you sold, which you did, right? It was going sideways and then it was going down. You did sell short. If you did, you're going to have to buy to cover and we're going to go the other way. So when people say like the algorithms are stopping me out and picking me off and this and this and that, it's really this is happening. You have this aggressive move that's countered by a more aggressive person or algorithm or buyer, seller, whatever you'd like to say. But that's why the rev strat's important, because you're always going to have normally a more explosive move on a rev strat. And let me just show you one we traded recently. You see NOC. So it's like, what happened? Well, the buyers bought it up. You had the 3. So they tried to buy it up. The sellers came and sold it down. Then they go inside bar. You see buyers tried to buy it up, but they stayed inside. So it's like they fought, and then they took a break here. Then the seller came back and the seller was like, yeah, we're going to hit the bid. They hit it. And then they reclaim coming back above that scenario 1. That's going to be a potential rev strat because they tried to sell it, but the buyer came back and they're rejecting those sellers. So when this goes 2 down, 2 up after the inside bar, you can see it's a big explosive move. In 2 days, this moves $33, 7%. So if you understand time frame continuity, what we say is if this occurs and we're above the month, week, day, and 60 opens when that rev strat breaks, we have zero reason to believe it's not going to go because you just matched up a more aggressive buyer with the monthly buyer, with the weekly buyer, the daily buyer, the 60 buyer against this aggressive seller who obviously was wrong. They're really wrong. So that's why the rev strat's important. Now, the same thing is true. You can do this in one bar. So if we go to the 1 bar rev strat, you're going to see like this: inside bar and then 3. The 3 by itself is a reversal because in this case, it gaps down, right? And it was going down. 2 down, lower highs here to the previous bar, lower lows to the previous bar. It was going down. And then when it goes scenario 3, it's making higher highs. Now it's going up. So the 1 bar reversal is the scenario 3. The 1 bar rev strat is the scenario 1 followed by scenario 3. As far as how we play these, you can play on the reclaims of the mother bar lows. So you can just buy it right here. When this goes green, you can buy it, put your stop right against the lows. You can also play the reclaim above this inside bar low here, or we can use lower time frame signals to do that. But there's no, specific trigger on this one. It's just we need to reclaim those previous lows. And in this case, most often 1 bar rev strats occur on gaps, but they can occur in other ways. Just most often they'll occur on gaps. And obviously you can have this both up and to the downside. Then the last one, this is a little less common, but it's the 1-3-2. And this is good because you're pairing that equilibrium with aggression, because the 3 shows aggression. And in this case, we're now going to have to talk about hammers and shooters. So what we'll see is we have an inside bar followed by a scenario 3, followed by a 2. So what happened? Well, they sold it, then they agreed on prices, going sideways. They tried to take the offer and bring it higher, but they got rejected below this open with a rev strat reclaiming this bar's high, so you could have played that. And then they made the new lows. And once that occurs, we've already hit our target. Because remember, if we go back to the 1 bar rev strat, the magnitude of the 1-3 to the downside is to take this out, which is slightly offline here. The magnitude is to take out the low of the bar prior to the inside bar. So when we go and look at it, did it do that? It did. So new highs, fails, makes the new lows. And then since it hit our target, it can come back. And you can see it comes the other way. So we have a broadening formation in here where they sideways and then pokes up, pokes down, and then starts coming back the other way. And then it hammers. What this tells us is if that seller wanted to, they could stay short because it hadn't came back above these highs. They could still be short against the highs of this bar here or wherever they got in. So when this bar opens and we have the hammer, which is this big lower wick with the small body, 1, 3, 2 above this black line, we can expect that this 2 is to the upside and the buyer's probably going to win out. As you can see, it's sideways. They tried to buy it, then they tried to sell it, then the buyer came back and blew those sellers out of the water. Up they go. And these are really powerful 8x trades. They love this setup, and there's a good reason for it. And you can see the same thing, the 1, 3, 2 on the downside. We don't have to have a hammer or shooter, but we do prefer it. And as far as shooters are concerned, it's going to look like the opposite of a hammer, just an upside down hammer, like one you would hold in your hand. And as far as the importance of hammers and shooters, you may have heard it said before that displacement is important, or that fair value gaps and, whatever you want to call it, like inverted fair value gaps, like IFVGs, all that type of stuff. People are always going to talk about that, but what they're actually trying to talk about is hammers and shooters. Because in order to have a candlestick that looks like this, where it traded down and then back up, you're going to have price action that opens here, trades up, aggressively trades lower, aggressively trades back up. And then if you're looking, inverted fair value gaps and whatnot, anything in here, what you're actually trying to track is the fact there was an aggressive seller and there was a rejection of that selling with a more aggressive buyer. And that's what hammers and shooters will show you. And they may not always look like a hammer or a shooter, but that's what it's trying to capture. The problem is we don't know for a fact, unlike the 3 universal truths, we do not know for a fact if this seller stayed short or if this seller covered their short position as price rallied back. Because this could either be a new buyer entering the market and all those sellers have a big problem on their hands, or it could be those sellers covering their short. So when this signal breaks, if we break this high the next day, right, we have the hammer to the upside. When that breaks, if this seller is still short, that should break and just go right away. Now, if it breaks and then it comes back right away, that seller probably was not still short. So we don't know if the hammer or shooter is true trapping of participants until the break occurs and it stays up, or until it breaks and fails, which is the one caveat with the hammers and shooters. What we can know is if the analysis is correct and we have trapped people in short or long positions, then pairing that with continuity and with the broad informations and the 2-2 reversals, the 3-2s and whatnot, you're going to have a really explosive trade. So they increase the odds. We just can't guarantee that they will work every time because of the fact that we don't know if they covered their short or if they exited their long when it comes to shooters. I know that was a lot. We might be going quick. If you have any questions on that, let me know, and I'll take a few questions here. I'm going to take a sip of my water and take a little break for my voice quick. All right. So I had a question. Yes, you can use it for futures. Do you think a reversal to the downside spy? We'll talk about that. On a 3-1-2, not sure why you said we can expect that this 2 is to the upside. We don't expect the 2. We do, but this is what we would mean by that. When we look at a chart, we're always asking what's the next scenario 2, because we trade scenario 2s and failed 2s going 3. So we don't trade 1s. So we go to a 3-1-2. Depending on if it's closer to the upside or downside, we'll expect the 2 up or 2 down. So like, let's say this bar closed like this. This would be closer to the upside. We would expect the next 2 to be up just because it's closer to doing that. So that's what I mean by that. Yes, this video will be posted. The 1-3-2. Yeah, so when it comes to the hammers and shooters, since this is closer to a 2 up, we would expect it to go 2 to the upside. Doesn't always happen, but we expect it. And since we don't enter unless it becomes a 2, if it doesn't become a 2, then we get out, or we're not even in, because the break of that 2 is the entry. So let's say it opened. Let's say it opened and went like this. There's no trade. It's a 1, right? And then it would be closer to the 2 up the next day. That'd be the 1-3-1-2. So hopefully that makes sense. We're going to talk about signals and probabilities and stuff. We're not to that yet. We got to keep going. So that being said, it's a little bit of the signals, right? There's also 3-2 reversals, which are pretty self-explanatory. Not always will they occur and look just like this, but these are the ones we like to trade. They'll mostly occur at the open of the day on the 60 basis, or when the daily gaps, when you see something like this. There's also continuations. So continuations, when it comes to inside bars, it's when the scenario 2 is in the same direction as the bar prior to the inside bar. So you can see 2 down, so red going lower, and then sideways, and then it's red going lower. That's a continuation. Same thing to the upside. We prefer not to enter on continuations because we don't have a reversal occurring where we have traders on the other side of our trade getting stopped out. We prefer to enter on reversals and add on continuations. So you can see green, inside bar, green, continuation. Same thing with the 3-1-2s, up or down. We also have what we call momentum, or MOMO. So MOMO simply means you have a very aggressive seller or buyer in the market, and you get a brief pause followed by an actionable signal, such as a hammer, shooter, or inside bar, or rev strat, and that's in the same direction as the previous selling or buying. So for example, you can see big sell, then they go briefly sideways, and then we have another big sell. That same seller comes back to sell again. And this is paired with higher time frames because you'll notice there is no target. So we don't prefer to enter on these, but we do use these to add. We will also see the same thing here. Big sell followed by little inside bar, followed by another big sell. We call this the 2-1-2 measured move. You can see 2-1-2 up, 2-1-2 down. And we need a pair, if we're going to play continuation, we need to pair it with a really aggressive seller or buyer, because that's what makes this a higher probability setup. If you have this, not as aggressive seller and buyer in here, it makes it less probable to occur. Yeah, the cheat sheet, it's all over my Twitter. It's also in our Discord in the announcements. If you go to stratalerts.com/Discord, you can get in there and check the announcements channel. The last thing on this page we're going to cover is the PMG. So the PMG is what we call a cluster of previous highs or lows. So it can be found by looking for consecutive higher lows or lower highs, or just clustered pivots. What that means is this. You can see we have higher low, higher low, higher low, higher low, higher low. Then we have our reversal signal, the inside bar signal, followed by a 2 down, 2 up, 1 2 down reversal. Back through all these higher lows. What happens is if you're buying, this reversal causes the first guys to start selling with a new seller entering the market. So you have a seller entering the market and you've got guys who are previously long. So when that happens, you take everyone out, because the first buyers to go underwater sell, trigger the next buyers to go underwater, and they sell, and they sell, and they sell. And when you sell while you have an aggressive seller that's also selling, you have all the buyers selling and the seller selling. There's no one buying. It's done, right? And that's something good to know about. What we say is it removes liquidity from the market. So you can think of it like this. You have that continuity where you find the algorithmic buying and selling. It's like if the algorithms are selling, the bid's going like this, right? Now, if the bid's going like this and then you hit a previous low, or you hit someone's stop order, it goes like this and it speeds up. And then if it does that and triggers the next one and then it speeds up, you're going to have this where it goes like floors falling out. So we can expect when we pair a signal with a pivot machine gun, ideally with full time frame continuity, it's really going to go. That's something we look for. And just to show you an example, Sarah literally traded one of these today. We go to UPS on the daily. You're going to see, just like we teach, higher lows. Here's your shooter actionable signal, 2-2 reversal. We'd get short here, 120.07, and then boom, takes them all out. And you'll notice this is what causes price to speed up. It does this whole move in 3 hours, and that's really good to know about. Yep, UPS, exactly. All right, and there's also like home builders today. Had a little bit of that. You see all the higher lows, and then here's your shooter. Boom, down they go. We go to Staples today. You see, here's your shooter. Here's all your pivots lined up. Boom, take them all out. Right? It wasn't as crazy today, but it's all the same thing. And every market's going to do this. So that's something you want to know about. And this is why we also want to trade signals back through a broadening formation, is it removes liquidity, causes things to really get faster. Verizon today. And it was just a gapper. If we look at the daily and we zoom out, we had all this stuff we came back through. It's like really gunned them. But I don't want to get too off track here. It's already a long video, right? So now that we have a little bit of understanding on the signals, let's talk about time frame continuity. So this is going to be a little bit of a longer lesson, and I'm going to leave a few things out, but I'm going to do my best to cover all of it here. So when we talk about time frame continuity, we talk in terms of control. And what I mean by control is, do the buyers or sellers have control right now on price action? That's what we're looking for. Is if we can identify who has control right now, then we can identify signals with those guys who are buying or selling right now. We can trade them back through pivot machine guns and broadening formations, and that's what we want to do. So the first thing is, when we reference continuity, we talk about each chart as a group of traders, because remember, the data is brought together. You have all these transactions like floating around. You bring them all together. You have this group of transactions. So if we look at a monthly chart, what it's actually showing you is anyone who has created a position, added to a position, or reduced a position during the month. So the monthly group tells you what they're doing this month. It includes you. If you're trading this month, it includes Goldman Sachs. It includes everyone. Just the monthly group. We call it the institutional group because the banks, institutions, hedge funds, etc., those are the guys that normally are moving the market. So we call it the institutional group. The weekly group, same thing. Anyone that bought, or you could say created, added to, or reduced a position during the week. The daily group, same thing. Created, added to, or reduced a position during the day. And then the 60 group. Anyone that has created, added to, or reduced a position during the 60 minutes that opens at the bottom of the hour, closes at the top of the hour, or closes at the bottom of the hour. So you can see each 60 in here. It's like it goes green. Yep, they're buying. New 60 opens, goes red. They're taking profit. New 60 opens, red, then green, and then they're buying. 60, red, taking profit. Then 60 opens, they're buying, right? So when we look at charts, we say each new open matters. Because if they were buying last month, but the new month opens and it goes red, they're not buying anymore, right? That's something you want to know about. For intraday trading, which I know a lot of people have been asking about, since we use 4 or more time frames, if you're going to do an intraday analysis of what's going on, you're going to use the 5, 15, 30, and 60-minute group, and ideally at least the daily group. The big thing is, if you're a scalper or whatnot, you still want to do higher time frame analysis, which we may touch on later in this video. But these are your intraday groups. During higher volatility, that's decides the size of the group you can go after. So like right now, the VIX is at 30. You can trade just the 60 group and it's going to move, $5 each 60 minutes. That's a good thing, because we're doing $5 days, a year ago. And now we're doing $5 60 minutes. That's really good for trading, right? You should be killing it if you're a stratter right now. And you can get even down to the 1, 2, 3 minute, even the second charts if you want to go crazy. Not everyone's built out for that. So don't you feel like you have to. Now, we've already touched on this slightly, but we have periods of continuity. So full time frame continuity is when they all agree on direction. So the last price traded is above the month, week, day, and 60 opens. It has full time frame continuity up. That is what we would call it. If the last price traded is below the month, week, day, and 60 opens, that is full time frame continuity down. So you can see charter here, it opens the month and goes red. Then the week has a 2 up, 2 down reversal. So they're selling this month and this week. Anytime the day is red during the week, those algorithms are selling that day. And this was it was like a friggin' 2,000% trade. This was nuts. So you can see each 60 during the week, they pretty much confirmed, besides right here, there's a slightly green right here and right here. So algorithmic sellers all week. This is the type of stuff we want to trade. I'm going to find out where those guys are. And I will take a little break. Solanke, I appreciate it. Just answer those questions for me. That's awesome. So when we have full time frame continuity, it tells us the level of aggression of the buyers or sellers is high. And it cannot be disputed. So no one can come in and say, that's not true, because at the point of full time frame continuity, all known participation groups, like we said, all known groups are confirming each other, and thus all those groups are in control in the same direction. Therefore, this is a universal truth of price. We also have what we consider conflict. So full time frame continuity, that is full control. All time frames in the same direction. Conflict is when any time 1 or 2 candles are a different color to the others. This is what conflict is considered to be. So for example, if the month and week are green, it's going up this month and this week. Cool. But if the day is red and the 60's red, today and right now, it's not going up. So it's conflicted. Today they're selling, right now they're selling. But this week they're buying, this month they're buying. And this is where you can get kind of choppy price action. So we prefer to trade with periods of full time frame continuity where we have full evidence of the direction the market's going. This does not mean you cannot trade the day in 60 against these time frames. It just means we prefer not to do that. Pretty simple. During periods of higher volatility, since more volume goes into the 60-minute charts and the daily charts, when the market's really moving around, you can trade against this stuff. Just because the moves are going to be much bigger, you can do more short-term trades. Now, as far as types of continuity, we have intraday and standard. Intraday is, like we said, the 5, 15, 30, and 60. Standard is the month, week, day, and 60. During higher volatility, more volume is traded on intraday timeframes. Thus, intraday continuity becomes more important. And this is due to the fact you could see as much volume in 60 minutes that you'd normally see in a day or a week when the VIX gets really high. So the 60 minute, if we're getting as much movement on a 60 as like a standard day, a month ago, the 60 becomes your daily chart. So you're going to have the 60 minute as your day, the 30, 15, and 5 as your intraday stuff. And you're going to trade every 60 minutes like a new day. And you're going to really lay it on. You're going to make a lot of money if you do it like that. Now, we have the 4 C's of continuity. The first one's control. When we look at any chart, we have all 4 time frames up, the 60, day, week, and month. We ask ourselves which groups are in control of current price direction. So if it's just the day and 60 that are green, you could say the day and 60 have control, but they might be in conflict with the week and month. You could just have the 60 for control, where the week, month, the day are red, but the 60 is green. And that's like too much conflict. We don't even want to touch that, simply because you just have so little evidence. Doesn't mean you can't when the VIX is high, but we prefer not to do that. Or do you have full time frame continuity? They're all in control in the same direction. And then confirm, it's the same thing. Are all the groups confirming each other? Do you have full time frame continuity or not? Because if you do, you're not going to get out of that trade unless that changes. And then the last one, we had a typo here. Conflict. Are there groups in conflict? So if the week is green, but the month, day, and 60 are red, the month, day, and 60, they're in control, but it's in conflict with the week. So you're never not going to have control, but you can have conflict. And we want to know about that, because it does give us less evidence on our trades. And then the most important one, in my opinion, change. Is the current group in control changing what we know about any of the other groups? So for example, let's say the day and 60 gain control. So let's say they previously were red, week, month, day, and 60, full time from continuity down. Then the day and 60 go green together. They would gain control to the upside. And then potentially they can change that week from red to green. And now the day and 60 were green, but now the week is also green with those guys. So if the day 60 and week are green, you would say, this week they're buying. Today they're buying. Right now on the 60 they're buying. I can't be a short seller because it's going up this week, today, and right now. That's not a short. And therefore, if it's going up this week, today, and right now, we don't have any evidence of the previous monthly group that was selling. Because if we had evidence of them, it'd at least be red on the 60 minute, but it's not. Now, as far as control is concerned, we need to know who is in control and for how long. The monthly group represents the institutional group and is the largest, so they last all month. The weekly group tells us who's in control this week. The daily group today, the 60 right now. So a lot of traders are like, well, I want to swing trade, and then they open a daily chart. It's like, what are you doing? You need to open a monthly chart because the monthly lasts all month. You get 20 trading days each month to swing. But if you open a daily chart and you don't even look at the month, you have no idea what the bigger groups are doing. So if that's you, this is the first thing you need to change. Start looking at the month, week, day, and 60 all at once so you have a full picture. Now, the next thing we want to understand is override. We already kind of explained it. But if the 60 and daily groups confirm each other for control, they override the monthly group for immediate control of what's happening today and right now. Now, this makes the flip, which is the new 60-minute open, super important. Because if the week and month are red, but the day and 60 are green, and then the new 60-minute opens and the 60 goes red, well, that would change control on the 60-minute. Because the 60 has direct control of right now. It would give control from the daily guys to now the week and monthly guys who were selling this week and this month. Now they're back. So it's really important to understand. The 60 and day tell us today and right now. So each 60 has control immediately, always. It's a matter of when the 60 goes green, how many other timeframes are green? If it goes red, how many other timeframes are red? Super important to understand that because control changes, right? And you could have something that was going up, new day opens, new 60 opens, now it's going down. And that's what makes swing trading a little harder because each new day and each new 60, they will either confirm what's happening or negate. Doesn't make it impossible, just makes it more difficult. Now, for example, we can see on a 60-minute basis in SPY here. So SPY gapped up. It made a new high on the day. So it started as a 2 to the upside on the day, right? It was a 2-2 reversal up. but then it went red. In order for an outside day to occur, it has to go red first. So the second it opens and goes red, it's coming back in, right? What we'll notice is the month was still green. The week was still green when this occurred. It was somewhere up in here when it gapped. So because of that, the week and month, they were confirming each other. But the day and 60 were confirming each other for immediate control today and right now. So they gap it up and the sellers are in here today. The first 60 of the day. The new 60 opens. It does go 2 up, 2 down reversal in here, and I'll zoom in. You see 2 up, 2 down reversal. Doesn't go anywhere. The new 60 opens here and it goes green. When that 60 goes green, it does give control back to the week and month groups. But remember, how long does the 60-minute last? It lasts 60 minutes. So for 60 minutes, they were trying to buy it up. Now we ask ourselves, did that change the day? The daily open is right up in here. It did not change the day. So when the new 60 opens, we're at a risk of that daily seller who we still have evidence of because the day is still red. That seller could come back. So the new 60 opens right here. When that ticks red, today and right now on the 60-minute, the sellers are more aggressive, followed by a 2 up, 2 down reversal. And this 2-2 reversal on the 60-minute gives controls to the seller for 60 minutes. And you'll see it hits its magnitude. These 2 bars go compound 3 to this bar right here by hitting its target. Then it's either going to continue or it's not. If we were just looking at this 60 chart and we cut off this side, what we would say, I'm going to, forgive me, but let's say this bar doesn't exist. We're closer to continuing down. So if we go open and go red again, the seller is still in control today and right now. They're still hitting the bid. So it opens, it goes red and goes 2 down again, and then boom, wipeout, right? All these buyers with stops against these pivots in here, they get taken out. How do we know that happened? Well, you'll see the week was green. When this 60 went 2 down again, it gave control to the 60-day sellers and then changed the week from green to red. And then it wipes out anyone that was long in the week. And then you could see they were done selling. End of day, the 60 guys come back. They do profit taking. The month is green. The week is doji doing nothing. And then the day is a scenario 3. And you'll see the next day opens. The day and 60 went green in here, changing control back to the week and month guys. I believe it went back to the highs. I don't have that in here. Now, is this making sense? I understand this part of the strat is hard. And I've had people swear at me and get mad at me because specifically of continuity and how control changes and how control is dictated by the day in 60. They'll say, Alex, I took this monthly or weekly signal. Then it went. Then the new day opened and it came all the way back and I lost money. It's because the day in 60 determine who's in control right now. So it's so important to understand the day in 60 tell you where it's going right now. Then the week and month tell you how much oomph, how much force you've got behind that day in 60. Because if you got every time frame green and then the day in 60 go green, it's like you got a ton of evidence that could get going. But if it's just the day in 60, you have less, but they still have control. So it's super important to know. So if you have any questions, I heard someone say it's a little confusing, let me know and I'm going to try and help you out. So for the change, there's 2 ways to play a change in continuity. There's always going to be a reversal that causes a change. It's normally a 2-2 reversal, can be an inside bar reversal as well. The next thing is you can use continuations, but I'd prefer, we don't want to sell at the lows of a continuation because when you do that, what you're betting on is the fact that this seller just keeps hitting the bid, which is, yeah, it's what we want to see. But I'd prefer you take the 5-minute reversal that causes us to make low of day instead of shorting low of day. Because if you take the 5-minute into low of day, you can create a winning position, have a nice tight stop on it. And if it doesn't work, you can just get out right away. Whereas if you hit the 60, you can still put a tight stop on it. You just have, it's going to be into what we call exhaustion risk, which we'll talk about. It's just, since we know the broadening formation happens, it's like, we don't want to sell new lows down here because it'll go the other way. We don't want to sell new lows down here, right here, because it's going to go the other way. So we know we want to enter on reversals, which is the opposite of that. And we'll talk a little bit about that. Hopefully we'll have time to get to it. Yes, always on, whenever you see a continuation, there's always stuff on lower time frames for the most part. Sometimes it continues on all time frames, rarely though. So in after hours, the day and 60 are closed. So a lot of people, what they'll do is they'll go on the weekend and they'll say, okay, I'm going to do my homework, which is a good thing. I'm not saying not to do this, but they're going to say, these are my top 10 picks, right? I went through 1,000 charts. These are the top 10. And they do it when the charts are static, because over the weekend, the week's closed, the day's closed, the 60's closed. You only have the month. So we're only looking at, monthly charts and then maybe potential new signals or reversals for the next week. Once the next week opens, then all those continuity levels open up and you actually will have the evidence that either confirms your analysis or negates it. And because of that, we're going to have our list, but we're going to look through the market and find where those really aggressive buyers and sellers are each new week, each new month. And a lot of times they happen to be on our list because our signals cause that to happen. But it's important to understand the day and 60 overnight or in the after hours, they're not in control as far as we're concerned. If you want to trade after hours or whatever, you can. I'm not saying you can't do that, but as far as I'm concerned, we are only looking at the, daily session, an intraday session. General rule: if you have a good idea of what's going on, you can trade right at the open. If you're like, well, it's all continuations, I don't have any signals, you can just hold off. On gappers, we hold off normally 30 to 60 minutes waiting for those signals to set up. On daily and weekly signals, right at the beginning of the week, you don't have to get in there right away. The only time you're going to get in right away is if you have a simultaneous break, which we'll cover. We just got to get there. We have a lot still to cover. So hopefully you guys are excited, but the strat, although it's simple, there's a lot of things you want to know. But I'd say the general rule is you can wait, 15 minutes and then start going after it. But I like to get them right at the open when we have daily, weekly setups going on. What's considered a high VIX? Well, the mean of the VIX is about, I want to say it's like 15 to 18, like 16 to 18. So anything higher than that is considered high, in my opinion. So when the VIX is down in the dumps, 14, 15, like you got to trade stuff with news. You got to trade long, green, and red bars. You got to seek it out. When the VIX is really high, you can trade the SPY every day on the 15 and 30s and you can go ham. If you're a swing trader, ideally you get the quarterly, yearly, monthly, weekly charts up for swing trading. We'll hopefully get to it, but I need to get to it. It's stuff we're going to get to shortly. Now, the last thing we're going to cover here. So the continuity will always confirm or negate itself. So during the month, you have 4 weeks. Each week will either confirm the month by giving the month and week control in the same direction or negate. So the weekly group either confirms or negates the monthly group for control. And the weekly group is confirmed or negated by the day and 60 groups for control. Therefore, each new open that occurs will either reconfirm what we know to be true or negate what we know to be true. So if we have full time frame continuity and then it's Friday and it all closes, the new week must open, go green, and then you would have full time frame continuity still. If the new week opens and goes red, you no longer have full time frame continuity. The same thing is true with the day and 60s. So you can see, like, for example, the first week of the month trades 2 to the upside. The second week will either confirm it going 2 up again or negate it by going 2 down. And that would change what we know about the month. And you can get inside bars, right? Which just means you're going to confirm or negate next week, because the inside bar tells us it hasn't done anything. But that's the rough idea. Now, I just want to show you the visualization of this. So this is with one time frame with some indicators, which you can find in the Discord under TFC bars in the indicator section. If you're stratalerts.com/Discord, you can find it. But what you'll see is they show the 60-day, week, and month, the colors. So you can see when the algorithms turn on and off. It's really obvious, right? So when all these colors go red, they're definitely algorithmic selling in there. You can see all the way down they go. So what we wait for is we wait for buyers to show up on the 60 and day time frames, which again does give the day and 60 control, but we prefer signals back in the direction of the week, month, day, and 60, because this week they're selling. We want to be selling this week. So you can see they gap it up in here. 2-2 reversal on the 60. Every time frame is red. That's a good trade. Down they go. And then you have slightly green corrective activity, slight higher highs, and then they make the new low of day. There's small trades in there, not what we're looking for. Then you'll see inside 60. Notice green day, green 60. This is what we consider corrective activity. The week and month are still bright red, and we're nowhere near changing those. You'll see then in here on the new 60s, they go double inside. Zoom in. You'll see it goes 2 up, 2 down after an inside bar. That's a rev strat. When that occurs, you have all time frames red. So you can see for 1-2 hours, they sell it. The third hour, they poke down, and then they take their profit when this goes green. And they're done. So what we want to do is we want to see corrective activity, green bars, and then look for signals back down. And you can see another example in here. 2 up, inside bar signal for a 2-1-2, and it breaks 2-1-2 down right below this with all time frames red, full time frame continuity. So you can get in right there. And you'll see they go green, 2 up, 2 down. Right here, you can get more. You can short it again. I believe this inside bar continuation goes down again. Then it goes green in here off the new lows, and they take some profit. And then you'll see they reverse and go back to lows again. Then you'll notice the confirming and negating. Down here is the weekly. This is the new weekly open right here. That week will either confirm the month that is red or negate. And what you'll see, new week opens, we don't have to go in there right away and short it. You could, right? But you can let it open. So you can see they go 2-2 reversal. It fails to take the previous week's lows. They go 2-2 reversal back up. This 60-minute negates the week from red to green. You see, we zoom in. 2 down, 2 up. This changes that weekly color right here. And then it goes 2 again, confirming. 2 again, confirming. At this point, this week, today and right now on the 60 for 3 hours, they're buying. And then you'll see the new 60 opens. The monthly and 60 groups go into conflict with the week and the day groups. They take profit of these initial longs to start the week. Did this profit taking change the week or the day? It did not. The next day opens. We have a 2 down, 2 up 60. When that occurs at the open, the day, week, 60 groups, they're all green. And you can see that buying continued. So you'll notice each new week, it can change what's happening. They're selling all previous week. The new week opens. They changed what they're doing. So we always pay attention to those opens. And I wouldn't suggest using this indicator. You can, but having all 4 time frames up, it's going to be a lot better, in my opinion. Now, to finish continuity, I know this is it's going to be a long video here. Hopefully we can keep it under 2 hours, but we'll see. To finish continuity, we need to talk about uncoupling. So the uncoupling is the first time during any month where the opening price of the 4 major time frames, the 60-day, week, and month, occur at different times. This means to us, it's like any Monday, the day and week opens are the same because they opened at the same time. Therefore, the higher time frame takes precedence. On a Monday, we only can identify what the weekly group is doing. So on a Monday, we trade weekly signals. That's what we want to do. You can also trade dailies, but we prefer those weekly breaks. On any new trading day, the day and the 60 opens are the same price, occurring at the same time. What this means is the earliest an uncoupling can occur, where we separate all the 4 major opens, is the second hour of trading on a Tuesday. This also tells us we gain more evidence over time. This does not mean we cannot trade on a Monday. And I know this sounds kind of weird. This kind of took me a little bit to figure out as well. I have a cool graphic that can hopefully show you a decent image of what this means. So in this case, we don't have the 60 here, but the concept's the same. So you can see the day will be this little circle. The week, bigger circle. The month, the biggest circle. So at the beginning of the month, you'll notice all the circles start right here. So the day, week, and month opens are the same if we open on a Monday. Then the second day of that month, the day open separates from the week and month opens. So right now we have a monthly open that we know about. The week is the same as the monthly open, so we don't know what the week is doing. And we have a separate daily open on the second day of the week. And then the rest of the week, you have a separate day and a separate month open, and that's it. So we only have 2 time frames giving us data. Then the second week of the month opens. It will either confirm what the previous week was doing or it will negate. In this case, you're going to see Monday, the week and day opens are the same. The week has now separated from the month. So now we have a month open and a separate week open, but the day and week are the same. The second day of trading on the second week of the month, the day open separates from the week open, and the week open has already separated from the month. So we have a separate day, week, and month open. And then you'll notice each week this occurs. Monday, day and week opens are the same. Then they separate. Monday, they're the same, then they separate. Now let's say this big circle is a daily chart or a day. And then we could say each one of these slightly smaller circles is a 60-minute. So the first day or the first 60-minute of the day would be this right here. This and the day open will always be the same at the start of the day. Then the second 60 opens and they separate. And they're separate, separate, separate all day. So as time goes on, we gain evidence. The reason this is important is because if we don't have a separate open, we don't know what the weekly group is doing. We only know what the month group is doing. So if we were just showing it based on how much evidence we have, I can delete this because that doesn't give us evidence, right? I can also delete this day right here. So right when the new month opens, all those are the same, right? This is the only evidence we have, just one time frame. And then we have the intraday 60 time frames. Then the new week opens. We still don't have that first day of the week. You see, that's going to be a true for all of these. So this is where you're going to have the most evidence, right? When you have all the circles, you have the month, you have the week, and you have the day, right? And therefore, you can see this would be where we have the most evidence, and that's what we want to know about. So when we look at this, when people say, I'm going to hold off and I'm going to wait, this is what you're waiting for. You're waiting to have full evidence, because once you do, we can be more definitive. Whereas before, right, if we're new month and the week opens the same as the month, because we opened on a Monday, the new month on a Monday, we want monthly signals, but the weeklies, we don't know. We have no evidence of them until the second week. So it's just important to know we gain evidence as time goes on. Doesn't mean you can't trade that first week of the month. It just means you have slightly less evidence. And I hope that makes sense. As far as examples of uncoupling, we look for reversals that occur on the uncoupling. So for example, UPS, we had the uncoupling, or actually, so uncoupling is reference to the month, week, day, and 60, right? Decoupling is when you have a time frame separate from another. So I'm going to be talking about decoupling. I don't have specific uncoupling examples right now. I think I have one I'll show you in a second. So the UPS trade, Monday, the day and week opens are the same. So you can see if you're in there Monday and you're trying to be the first guy in, you're the first loser. Down they come. Tuesday, the day and week opens separate. We have more evidence now. So when the week is red and the day is red, we have 2 time frames confirming our trade. Whereas on Monday, we just had the week. The day open was the same, therefore it did not matter. It was not new evidence or more evidence. So in this case, second day of the week, we decouple and we have a 2-2 reversal. We like pairing these together. If we go to home builders, first day of the week, they bought it. Second day of the week, decouple, reversal. That occurred with full time frame continuity. So what we would say, right? The month was red going into the new week. The week did have a signal, but the month was still red, right? Below this. So they tried to change that, right? The first day of the week, the day and week opens were the same. The week and month opens were separate. So we did have a period of full time frame continuity for a short while in here. But what happened? You're going to see the first 60 of the day on Monday, where we have the least amount of evidence. We had the 60-day week and month green, was the least amount of evidence. The second 60 opens, there's no buying going on. Third opens, they're just stuck right in the middle of this range. So they came in to start the week and they're like, boom, we bought it. And that was all they got. Then you'll see they did go 2 up and then 2 down. They start bringing it back in, which changes the month back to red here. And then we have an inside bar 60-minute, which will confirm or negate. So in this case, it changes the week open this morning. It goes inside 60 down, changes the week to red. So now we have a red month, a red week, a red 60, and a red day. So you can see we had less evidence on this and way more evidence on this. Hopefully that makes sense. Now, as far as like a bigger example, Mondelez was a really good one. So the first week of the month, February in here, they had a 2 down hammer. So the second week of the month, when they decouple, is the month opened on a Monday, we are going to have a 2-2 reversal. When we zoom in, we also have a pivot machine gun we're coming back through. So on the second week of the month, they uncouple, or I would say they decouple the month and week open. So we have more evidence and we have a reversal. So we can use that to take this trade in here. The stop at the lows, we're just getting about $1.30. At this point, it's still up about 16% or $9.47. So hopefully that's making sense, right? It's the second bar of a time frame lower. So second week of the month, second 60 of the day, second day of the week. You could say second month of the year, second quarter of the year. Those things matter too. And yeah, I had someone ask around Turnaround Tuesday. That's what Turnaround Tuesday is. Turnaround Tuesday happens on every time frame. Just specifically on Tuesdays, we like to look for it because it always happens every Tuesday and you get nice big trades. And that's what we had, UPS. What is it? It's a simultaneous negation of the week. It started 2 up on the week, but then they reversed it 2 down on the day here. And it's the decoupling of the day and week opens, which gives us more evidence. So what are they going to do? They're going to hit the bid and they're going to take these guys out. As far as taking profit, you're going to do it. Oops. Just trying to type it in the chart. I don't want to take too many questions here, but you had a question about taking profit on longer term stuff. It depends. You have to choose what guy you're going to be. So you can see, let's say we're a yearly guy and we scan yearly signals. How do we get into Costco? Well, it's going to show up on your 3-2-2 scan. Here's your 3 down, 2 down hammer. That's a 3-2-2. You buy it. Until that reverses, you're in. This is your inside bar add right here, 170.04. Till that reverses, you're still in. And it hasn't reversed yet. So if it's going to reverse, it would be a 2 down or a 3 to the downside. Depending on the type of guy you're going to be, if you're going to be a yearly guy, wait for the yearly reversal. If you're going to be managing this like on a monthly basis, you can do that, right? You're just going to be in and out a lot more. So if you're longer term, like big holds, yearly charts where you want to be. And if it's really volatile, you can switch down to like a quarterly if you want to do that, but hopefully that makes sense. All right. So we did talk about continuity. We understand signals. So what's the trade plan then? Well, the trade plan is we want to trade back through a broadening formation using signals paired with the broadening formation, paired with full time frame continuity. We call these combinations. So for example, if we go to my neat little program here, the best trades look like this. You're going to have a broadening formation and they broaden over time, which means they go small and then they get really big, right? We want to trade this part of the chart, this really big part. So it will start small and this is where you lose all your money, right? If you're like, hey, Alex, I stop out all the time and lose all my money. You're trading this. This is what happens. So you can see it goes down and then back up, then back down, then back up, then back down. Everyone gets killed. And you're like, oh, it's going down and then back up again, another 3. And it's small. As far as how we draw broadening formations, it's drawn based on the 3. It's drawn based on the compound outside bar. So for example, if we have this outside bar here, we draw right to left to make the line as flat as possible. So the broadening formation looks like this. Is we have a 3, that bar is outside of everything left in this little pattern I'd drawn out. We can also have compound threes. So for example, these 3 bars, we put them together from our 2-2 reversal. These are an outside bar to everything left. So we have a new high and a new low. So the broadening formation is the objective chart pattern that no one's telling you about. Because what we do is we scan for the signal. So we'll scan for this shooter signal. Then we will draw out the broadening formation. So if we scan for this, we're like, that's a 3-2 up and a shooter. The next bar right here is closer to a 2 down for a reversal entry short. I'm going to draw my broadening formation from here to here and from here to here. And what that tells me is if this signal is successful with no reversal against me, hint, you know what a reversal looks like, right? If it doesn't reverse, it's going to go and take out the lows of this range. And then it will either continue to confirm what we know to be true by opening and going 2 down again, where I can continue to hold my trade, or it will negate by reversing with a reversal against me, such as the 2 down, 1, 2 to the upside, where I cover my position. So in this case, we don't trade this stuff in the middle. Then we can start trading this much bigger range. We can take it short here, below this low, with our stop against this, very tight. It works. Then it continues. We can stay in. Then it goes green here. When it goes green, we can either choose to reduce our position or we can choose to hold because it hasn't reversed yet. This is still lower highs to this high here. So you see 2 down, 1. Then it goes 2 to the upside. At this point, you are either forced to cover your trade or make sure you manage your stops to break even to guarantee if this does come back, you do not take a losing trade. And then in this case, we call this country western. We can short it here and we can buy it back here and say, if that works, it's going to take out the other side of this range and do it again. And again, they repeat. So it's like this can go on over and over. And this is why a lot of traders struggle with the strat. They'll say, Alex, how do I know if they're stopping people out or if they're reversing? It's the same thing. It's like when it makes a new low, it stops these guys out, right? So if you were long in here, you did get stopped out. Is it reversing? Well, here's your reversal back up. No, it's going the other way. You're like, Alex, well, is this going to successfully break out or not? Well, here's your shooter signal. If that reverses, it's definitely not successfully breaking out at that point, right? It's coming the other way. So we don't want to guess. We want to say if it hasn't reversed, we're still in. And therefore, we're going to use the 2-2 reversals, the inside bar reversals. You can use the rev strats and stuff as well to create winning positions. We're going to hold those winning positions until they reverse or until our target's met. So for example, I can't really draw it out in here. But if this is our broadening formation and we take the signal here, we can trail our stop up, 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 boom, reversal against, either flip it short or get out, right? And then it comes the other way. The same thing with any other signal in here. We just need to not get stuck playing low volatility. This is where you're going to lose your butt, right? So we don't want to do that. Now, as far as risk management strategies, and you're like, Alex, well, what if it, reversed down and then it started going back up again? We can talk about that shortly. But the whole goal of the strat is pair actionable signals back through a broadening formation, ideally with a period of full time frame continuity, or at least the day in 60 for control. Now, I know that's a little bit much, so if you have a question, let me know. Just about pairing the broadening formation and the signals together. And while you guys type those out, the last thing I want to add, the bigger the broadening formation is, the more likely it is to work. And this is something like if you were, it's like a gospel for traders, because the bigger the potential target is, the more likely it actually is to do it. It's like, that's the best news you've probably ever heard in your life. Because when we go to stuff like Meta, if we're a quarterly guy and we see this hammer quarter right at the beginning of a new yearly open where the year goes green, right in 2023, we can take that and say, if this doesn't reverse, it's going up there. That's where it's going. And you'll see, did it reverse? Nah, it still hasn't reversed. You got a pretty big wick up in here. So maybe they do, next quarter in about 20 days. But this is higher lows all the way up. You're just in. Buy and you're in, right? There's no messing around. So the bigger it is, the more likely it is to work. And I'll show you one more for the futures guys today. on the NASDAQ this morning. This is what I mean. Traders will get stuck trading in this mess right in the morning. You know, some mornings they're bigger, some mornings they're smaller, but they get stuck trading in here, right? Which you can trade successfully. There's still pretty good point moves in here. But then later in the day, they're like, oh, I missed the real move. When this range gets really big, and then here's your 2-2 reversal pivot machine gun to play it long. And boom, how many points is that? 350 points to the highs. So you buy it, you're in, 2-2 reversal, you're out. And that's how it works. So the bigger it is, the more likely it is to work. Broadening formation, thank you for bringing that up. So broadening formations expand. They are called broadening formations, so they broaden, right? Now, when it comes to a trending market, what's going to happen is you will have a higher time frame too. So like, let's say this month on the NASDAQ, what is this? That's a 3 shooter to expansion of the broadening formation. So broadening formations expand. They get bigger. They broaden. That's what they do. So when you have a broadening formation that's expanding, it's going to be directional. And what that means is during this month, if it's directional, we're going to see what we would call like a lower series going on. So you will form the broadening formation, and then it will expand out of the bottom in the direction of that higher time frame. So it's like you'll form this broadening formation, then it expands the bottom in the direction of the bigger time frame. You'll see over here, we had one in here. Then it got stuck in the middle, chop them up, and you'll see like this. You're going to form this broadening formation, and then you're going to get signals to make money. It's going to go to the bottom. And since you have this higher time frames already going down, we expect them to stay down there. So you might get lower broadening formations like you see. Another lower broadening formation, then they go down. Slight higher highs, and then they go down. That's always what's going to happen. Now, the biggest thing is it needs to stay down or stay up when you're doing that. Because the broadening formation expansion, if we go to the SPX on the monthly, you'll see this very clearly. This will teach you everything you need to know about how these work. So we're going to go back to, when this started, just because why not? Let's go to the 1940s. So we're going to see the broadening formation in here. They get stuck in the middle. They make the lower lows. Then they start going the other way. Where's that going to go? Higher highs. Take these guys out. Here's the broadening formation. Then it gets out of it here. The way it works is, let's say we have positions we took in here. At this point, you'd have a break-even stop, right? You can say it's a 5-minute chart. You can do whatever you want. Here's another broadening formation that formed here. You see the hammer signal. If you zoom in there, it's like you really zoom in. See the broadening formation, really small, bigger, hammer signal. Boom, no reversal against. This is where you'd make all your money. The 3-2-2, boom, up they go, right? Once it gets outside of this broadening formation, all of your stops can be managed to the highs of this stuff. So as long as this line, as long as we stay out of this, we can hold that position. You can trail your stops up if you want to, right? But at this point, we don't have to do anything. And this is where you want to be. You want to get the trades in here back up. You reduce the trades. You want to get more trades in here back up. And then once it expands, there is no reduction. You get as long as you can to get to the top of this. And then if it's going to expand, it's going to stay out. So when it comes to broadening formations and like in breakout trading, it's either true or it's false. So it's going to broaden. It's going to go boom, boom, boom. And then eventually it stays out. And now the breakout's true. It doesn't reverse. And then it keeps going. So it's like, Alex, how do I know when it's going to keep going? It doesn't reverse. So it keeps going. You know what a reversal looks like now. So you don't have to ask that question. If we go to like a quarterly, you can see on the quarter, there's 2-2 reversal here, there's 2-2 reversal here. No reversals all the way up in here, and then reversal here, boom, that's when you got to start doing something, right? Or get your stops even. And the 2-2 quarter here, up they go, and then reversal here, that's when you got to start doing something. Then we have a 3-2, which is a broadening formation expansion here, and then that's successful. They stay outside of this level. So now we can leave that drawn out and say that's expansion. This is getting bigger. And what they'll do then is they'll start trending more often than not. You're going to see the broadening formation here. 2-2 reversal, you're in, goes up here. Did it reverse? It didn't. Nope, kept going. You see momentum hammer here. Boom. You're going to see them broaden. See the broadening formation, inside bar signal, boom, you're in, up they go. Broaden again, higher broadening formation, up they go. And then look at this, right? You're going to see, so we couldn't draw it out previously, it'd look like this. So there's signals in here to cause this to happen. Then this signal breaks, pivot machine gun of these guys, brings it back into the broadening formation. So where's that going to go? To the penny here. Then it goes inside bar, and then rev strat, the 1-3 when it's above the open here. Then it's going the other way. Then you'll see this broadening formation. It's bigger, and then they start expanding this. It acts as support with a higher broadening formation in here. You're going to see boom, boom. Did you see how we draw it out here, right? And then look at what it does to price. Boom, 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 boom. It nails all this stuff without even redrawing it. And then eventually you get out of that and you expand it in the direction of the bigger time frames. So like in this case, you get the higher highs in here. You'll see they do pull it back in, but then they reverse, firm back up, boom, to the highs, acts as support, and then off they go. Right, they're gone. We just keep going through here. But let me just show you some of the big ones. Here's the 08 crisis, new highs, 3-2-2 quarter, inside quarter momentum add, boom, boom, boom. 2-2 reversal, cover or flip it long, bottom of the broadening formation. Then you see slight lower lows, boom, slight lower lows, broadening formation, boom. Then you will see it expands out of that, starts another one. This goes expansion in here, like so, new low, hammer, rev strat, boom, expansion. And then here it is. This is your 2016, I believe, or 2018. New lows, new highs, COVID crisis. Uh-oh, 2 up in red. Boom. Changes continuity here on the quarter green. Boom. And then it expands. 3-1-2 Chicago all the way up in here. And then in this case, it's going to be a little harder to see it, but we had an outside year. New highs to this stuff, new lows. 2 2s in here. Did reverse back down. But then 3, 2 expansion, and then another expansion, expansion, and then here's your 3 here. So we go to the monthly SPY. We're going to see our current broadening formation looks something like this. It's trying to go and get bigger still, as the month is still red. But over time, you will notice they expand, right? Once you get out of it, it gets bigger. And then you'll start a new one, and then it's going to do the same thing over and over. I will talk about stops in a short minute once we get to risk management, but we just need to understand these broadening formations and how the signals will time your entries back through them. The bigger it is, the more likely it is to work. And then once it expands, you stay in. Once it stays up there, stays down there, you stay in. When you're looking at broadening formations, you're going to draw them when the new month opens occur and then closes occur. So like SPY on the month goes 3. Once it's a 3, you can draw it. Whenever you get a scenario 3, you can draw it. Then the new month opens, pokes the highs. There's your broadening formation high. Boom, back in. And it closes out. We can redraw it to include the new data. Then it opens, goes red. Where's it going? Down there. Boom, takes them out. And if you wanted to redraw, I'd prefer to wait for the new month open to redraw. But since it did take these guys out, you can redraw it like this. You can say that's our current broadening formation. But do we have continuity to go the other way? No, we don't. This month they're selling. This week they're selling still. So at this point, there's no bottom of this. It's still getting bigger, which is why I prefer to leave it drawn and let them expand these guys. Where if we drew it off the weekly, which if you saw my weekend video, I believe we did this. But below this, it goes into expansion. And then if it closes out of that, we just leave this drawn out up here. Is that making sense? Is there a trading scanner? Yes. I'm going to use this as like, shameless promotion here. Give me a second to pull it up. But we have been working very hard on a scanner for everyone with the strat, and it's going to be so much better than the old one. I'm like super excited. But here it is. So this is currently what the scanner is looking like. We still have some things that I want to change with it. But what it's going to allow you to do is scan for signals. And we will also be able to scan for continuity up or down. So you can see like tonight, what I'd want to do is scan for setups. And I want to scan for, well, it's Tuesday night. So we can scan for, inside bars. And I can look for any inside bars. In this case, we still have this little problem here, but we go like this. So all the inside bars, here's all my setups. And I can filter them for the highest ATRs, filter them for the highest price, whatever I want to do. We can also do this by average volume, get the more liquid names. But here's the scanner, and we can see going into tomorrow, Palantir is inside, which I want to double check just to make sure the data is correct. Yeah, so Palantir is inside, MU's correct, or inside. Wells Fargo, PayPal, Citigroup, all financial names, right? Some utilities are inside in here, some staples. So we can go in here and we can do our scans for the setups. In the near future, we're going to have the week, month, quarter, year, and all that stuff. But as you can see, we can scan for this stuff. We can also scan for setups that are already going. And when you click on any of these names, it obviously pulls up the charts. A lot more pretty than the previous one we had. This is all editable. We're still working on this, still trying to make it, something we want to give out to people. And, we're probably going to change a little bit of this format here. The other thing I can show you is we can remove and add columns. Like, let's say I just don't care about any of this stuff. Just remove last price. Can remove sector if I want. Multiple time frames. Like now here, I just got a really simple scanner. And we're going to add a lot of stuff. We're going to have automatic tracking of strategies. We're going to have automatic tracking of the universes, the gainers, losers, that type of fun stuff, and signal alerts sent to phones and all the good stuff that you're going to want. So that is our little plan. If you're interested in that, you can go to learnthestrat.stratalerts.com/learnstrat. And I believe the link is in the description. If you do that, you can reserve your spot. This is going to be for the beta guys. So if you want to get the first version of the scanner be released to the public, this is the list we're going to send it out to first. So please go and check that out if you're interested in the scanner. And I also do post, strat content and stuff there. I have been a little busy, but we're going to have another post or email sent out, hopefully, within the next couple days here. Probably this video will be sent out on there. But that's, a little shameless plug here. Hopefully you guys enjoyed that. The scanner, a portion of it will be free. Everything else on top of that, like automated, alerts, strategies, entry, exit, like all that stuff, that's not going to be. We're not 100% there yet, but it's going to be similar to something like a TrendSpider subscription is what we're planning on. That being said, let's get back to where we left off here. So we left off talking about broadening formations and timing the signals. So we're always asking ourselves, what's the next two? What will it negate, create, or do? So we scan for signals once they have closed out. We can also look to set up signals with lower time frames. But for example, on SPY, we had the 2 up in red week here. So even without any of these bars on the right, we draw our setup right to left. You'll see from the top of this week to the left, this is the top of your broadening formation line. And then we look left and we'll say this low is lower than these lows. So we draw it right to left here. If you went in here and you drew this one, it's the same thing. It's telling us very similar information. So that's also fine. But this is the one we drew out. This 2-2 reversal, if that doesn't get a reversal against us, what this analysis is saying, what this broadening formation tells us when this is just 2 up in red here, is if this reverses, it does not reverse against, all of these bars on the right side of the chart are going to go outside bar of all of these bars on the left. So you can see a reversal causes all these bars to go outside of all of this. And that is what we're looking to do. So when it comes to how we're going to find trades, like we said with the decoupling, Monday night, we can scan for 2-2 reversals inside bars. You can do this every night of the week to look for trades. But specifically Monday night is good because you can enter swing trades on Tuesday morning. The second week of the month, we're always looking for 2-2 reversals inside bars. Second month of the year, we're always looking for all that stuff. And those times are important because that's when the opens separate. As the year goes on, we're going to have preference as to what we want to buy or sell. So, we don't have a lot of really green names this year, but like let's say VRSN, for example. So as the year goes on, this yearly hammer rev strat 1, 2, 2 it has all year to try and take this stuff out. So what we can do is combine signals across more than one time frame. Where if this yearly signal is in force all year, that is one signal for us all year. Any additional signal on the weekday, 60-minute, monthly charts will confirm or negate that yearly. So you can see in this case, January, we had the 2-down hammer week. This was above last year's highs when this broke. This hammer week reconfirmed the year. You're going to see the end of January, it went 2-2 week. As long as that week does not get a reversal against, the yearly, quarterly, monthly, weekly participants are all definitively buying. So until it reverses against us, we get to hold. Once we have this reversal against, we can either decide to reduce position, exit position, or keep a stop, break even on the position. And I personally will always aim to reduce or have a break even stop. Now, when this reversal occurs, if it hits its target, what does that negate, create, or do? Well, in this case, it's the second week of the month. So the month does go red to start the week here. But we're nowhere near changing that yearly signal. So we can say, although we have a reversal against us, I would prefer to hold my position from here because I still have 9 months, left for this trade to play out because we have all year. So it's important to understand how long signals last. Because let's say we have this 2-down week and then we set up a 2-down, 2-up reversal next week. We can take that trade and add back or add to our open position that we started at the beginning of the year. And now we have double the amount of position and we did it on an additional signal to confirm the year. Ideally after some red bars in here, so we have shorts to trade against. So we can combine signals across multiple time frames and therefore increase the odds of our trades working out. The more signals, the more evidence you have. They just have to stay good. They can't reverse against you, or else you don't have a signal going anymore, and that's it. Yeah, we can go to AMD yearly for another example of this. This year, AMD is going to go to 54.57 so long as it is below 11 or 117. So that is going to be what? A 53% haircut on the stock. At this point, it's still doing that. We still have 43% to go. So if you're going to take anything from this stream here, this might be something to take. We will also see MU may do the same thing. You can see they started the year green, nowhere near becoming a 2 to the upside. If that goes green to red, anyone long this year in MU may become a seller, taking out the RevStrat year, 1 shooter, 2 up, 2 down reversal, which would have a magnitude to take this out, 48.43. So since we have these yearly signals, let's go to AMD and show you a trade we took. Below 11790, we know we have a yearly signal. So the first trade would have been this 2-2 week, which did gap, which we don't prefer, to trigger that year. Or you could say it was the gap up sell in here to trigger the year. But I want to talk specifically about signals. We'll then see inside week to either reconfirm the yearly analysis to the downside, inside down, or attempt to change it by going inside bar reversal. Since we're taking last year's lows, this year is a 2 down. It's trending down this year. We prefer not to buy things that are trending down this year because that's obviously not a good buy this year. So when this goes 2 up, 2 down weekly reversal here, that is a RevStrat 1, 2 up, 2 down. When that occurs, the month is red and 2 down. The quarter is red and 2 down. The year is red and 2 down. So this year, this quarter, this month, this week, every single market participant, every single participation group that we can track is selling. So what is that going to do? It has to go and hit its target because what else is it going to do? If everyone decides to sell AMD shares when this breaks here, it has to go down, which is why we like RevStrats with full time frame continuity. Now, when this occurs, we have created a winning position and it looked like this. Until that position reverses, we can stay short. So we can trail our stops down or keep a stop right where we got it. And you can see we risked about $1.54. If this trade works, we will be risking $1.54 to make $55. This is where we want to be. Now, as far as how we'd like to manage it, if we get a reversal against, we would reduce the position by half, and then our cost basis increases, which we'll talk about shortly. But we would reduce it. So let's say we go 2 up. We reduce our position. Then let's say we go inside bar again. Now we have an inside bar signal. If that breaks down, we would add to the position. Create a position, reduce it to guarantee profit, and put your stop where your break-even price is. Then inside bar to get more. And then if that works, right, we'd like to see them take all this stuff out. So we're always going to create winning positions and then try and hold them. That's the whole goal of the strat. And we only do this with knowledge of the fact we have all year for this to drop. If we had no yearly signal, you have less evidence to hold it if it reverses against you. Is this 2-2 week to the upside if it happened? You'd have the whole week where you have this trade going against you. But on the year, it's still a reversal down. So you still have evidence this year to be short, just not this week. So it's important to know how many signals do you got? How long do they last? And where are they going? Where's the magnitude? Is this making sense? Awesome. Okay. Now, a little stuffy. The next thing I want to talk about is the holy grail of risk management. So if you're going to be a successful trader, your risk management is actually what matters. People go crazy about analysis and techniques. Our whole thing is like, hey, this is like how it works. There's only 3 scenarios. Everything's based on that. You can trust the fact that this is going to tell you, what you can know at any point in time on the chart. Now, in order to be a successful trader, your risk management is what really matters. So what's important to understand when we talk about risk management is the 80-20 rule. So we go back to ChatGPT here. It's like, what is the 80-20 rule when it pertains to trading? So if you don't know what the 80-20 rule is, it's a Pareto principle. It suggests that 80% of your results come from 20% of your inputs. So let's say you run a business and you have, customers that are complaining. 80% of your complaints will come from 20% of your customers. Let's say you teach students in class. 20% of your students are going to be doing 80% of the work to be good in the class, right? It's like, that's how it's normally going to play out. So in trading, 80% of your trading results or your profits come from 20% of your trades. So the key applications, according to ChatGPT, a small percentage will account for the majority of your profits. So we want to select good setups. We also want to let trades keep going, right? And I'm not going to, really mess around with the rest of what it says here, but we want good setups and we want to know what are the 20% of setups that actually go, right? And those are going to be what we call simultaneous breaks. So the simple thing is we can look at one stock across 4 or more time frames, and that's great. But you can also look at a ton of correlated assets on the same time frame, and that's even better. And the reason that is because when a reversal occurs in AMD is not the only stock in the market that we can track. We can also track NVIDIA. We can also track the semiconductor sector. We can also track Qs and SPY. So if Qs and SPY reverse when AMD reverses, and NVIDIA reverses, and semiconductors reverse, and technology sector reverses, when that happens, we have zero doubt. We're just going to hold it, right? It's like, it's definitively the whole market. You have algorithmic selling across all of them. So let me show you what that looks like. We scan for this AMD setup, this RevStrat week. We put that on our weekend video. Then we ask ourselves, what does the semiconductor sector look like? And where's the broadening formation there? Well, on the week, it looks the same as AMD. So we can draw our broadening formation. Say if this works, we're going to take the bottom of this broadening formation out. You could even say it's a delayed RevStrat. You have the 1 followed by the 2-2 reversal after the 1. So it's a slightly delayed RevStrat. So you could draw the broadening formation like this if you wanted. But the semiconductors and AMD broke at the same time. The technology sector had the 2-2 reversal. You draw right to left. It's going down there at the same time. When we go to the SPY, you had the 2-2 reversal at the same time. They're selling the whole market. Qs. 2-2 reversal at the same time. They're selling all of tech. So what does this do? This brings your analysis from what most traders have, which is, hey, this might happen. You know, this is likely or this is probable, to everything is enforced to the downside and it is definitively going to where we say it's going with the broadened information. But you can only have that if you do this across multiple correlated assets. So if you're not a stock trader, if you're just futures traders, you still want to look at the sectors. Because if I pull up the sectors and I look at the sectors on a weekly basis, this will tell me how much evidence I have to be short the futures, which obviously you've had to be short the past 4 weeks or else you're going to probably get killed a little bit. So when you look at them, it's like semis was also going down. Healthcares are going down. Communications going down this week. Discretionary, financials, right? The real estates are going down this week. The transports, the airlines, the retail sector, energies, not so much. Technology is still going down. Communications are still going down. Staples are going down. So what does this tell us? Well, the market must trade in the direction of the most scenario 2s and 2s going 3. So when I look at this, about 90% of the market's going down. So guess what? It's going down, right? It tells you what's going on. So when we say continuity, price must trade in the direction of the most 2s and 2s going 3 across 4 or more timeframes. We can also say week to week, the market must trade in the direction of the most 2s and 2s going 3 on a weekly basis across the whole market. Because we're picking up on algorithmic trading. If you're a 2 up, you're going up. It's an uptrend. If you're 2 down, you're going down. So if the whole market is 2 down, crash. You're done. And this is what it looks like, right? You can see, hopefully, you know, if you've been paying attention, like they all reversed. Communications reversed, SPY and Qs all reversed, semis reversed, tech reversed, all at the same time. Biotech's reversed. The OIH, XOP, which is your energy sector, reversed. Retail reversed. Jets, airlines ETF reversed at the same time. Transports reversed. They all reversed 3 weeks ago. So when you trade SPY and you're short SPY and you're swinging it, or you're a future trader, you short it and you don't get out because you got the whole market going down until these weeklies start reversing back up. And that's where the confidence comes. So you're going to bring your trading expectation from this is probable to this is definite. And I'm not going to, you know, give you financial advice and say, it's like, this always works. You're always going to make money if you do this. But I will say your analysis will always be spot on if you are doing it this way, regardless of your trading results, which I can't guarantee. So what we want to do is we want to line up when those simultaneous breaks occur and hold. And they will occur on a 60 daily, weekly, monthly, quarterly, yearly basis. So you just pick whichever guy you're going to be. You want to be a 60 guy and you want to look for him every 60 minutes, go for it. You want to be a daily guy? Go for it. Weekly guy? Go for it. Whatever you want to do. Now, obviously, bigger signals, more control, more volume, you're going to have bigger moves. So we prefer like the week, the month breaks, especially because you get longer to go after them. A weekly signal in SPY lasts a week. A 60 signal lasts 60 minutes. So which simultaneous break's more powerful? The weekly, right? So just remember, the bigger the time frame, the bigger the move, the more evidence you'll have for a longer period of time. Now, the other thing we can say is not only can we look for simultaneous breaks where institutional selling's going on, where every institution said, hey, trade desk, sell everything, hit the bid, do it this week and keep doing it until we're out, right? It happened, you know, this month too. We can also find where are those institutions actually putting their money? Well, when all the indexes go full time from continuity down, all the 4 Qs, SPY, Dow Jones, IBM, they're going to buy the VIX. And the VIX has risen, you know, double. It's gone double. What else they may buy? They may buy the defensive sector, which is your staples. For the past 4 weeks, they were doing that. And now this week, they're not. So now we don't even have the staples going up, which means they're just trying to sell everything. That's not good. The last ditch effort place to put their money is gold and silver and the gold miners. So you can see GDXJ, the junior miners, that's still firm. It's not going down this week. So tomorrow, maybe that goes up. GDX, which is the gold miners, that might go up tomorrow. Gold, that could be a 3-1-2 week to the upside tomorrow. You know, that's where their money's going. They're selling everything and they're like, give me gold and silver. The world's ending. That's how they feel. Now, if we go to silver, Silver, it went 2 up last week while the market got wrecked. And then it went 2 up again this week. So the buyers came back to buy more. That's something we look for. So we can say they're buying the precious metals and the rest, they just, screw them. They don't care. Besides maybe like the defensive sector is a little stronger this week. But hopefully that makes sense. And let me, read the chat and see what you guys are saying. Broadened informations, yes, we already talked about those. So please just watch it back. I bet YouTube's going to put in like a sections thing on it. Or maybe someone will be nice and put it in the comments below and put out the sections for the video. Why do we ignore pre-market data? Because we just don't need it. Like when you're trading the strat, the biggest thing with the strat is we don't have enough fingers to make the trades. Because like when Qs goes 2-2 weak, we can short every stock in the Qs doing that. That could be 50 to 70 names. So it's not about I need to have pre-market to get better fills. It's I need more fingers to make more trades. Because we could have shorted Qs, SPY at the same time, and you're still holding semis and tech at the same time. You could short any of the holdings within those doing the same thing, and you could be holding all of those short and the other 10 sectors that did it. So we don't need the pre-market. It's just not something we care about. We'd rather just, do the thing we do best. Bonds, yeah, you could have the bonds in there. What is that? TLT. And you could have interest rates. You could have, you could have all that stuff. You could even have like the futures, like lean hog futures and lead and palladium, and you can do all that stuff. It's just a matter of how big is your universe you're going to want to track, because this is like my full-time job pretty much. So, I've been tracking and doing this type of stuff for a while, but if you're new, I'm not going to be like, hey, go track these 30 things. Like, it's like, no, it's not a good idea. Sharing this sector grid? Yeah, I can. If you're watching the replay, it's in the chat. The live chat replay will have the sector grid link. Now, as far as risk management's concerned, let's cover how we can do that. So this is probably going to be the last part we talk about. We didn't get to much trade plan stuff, but it is getting late and I need a lot of sleep tonight. I didn't sleep much last night. So the simple way to do it is to short or buy, or short or long. And if it doesn't reverse, don't get out. So like Qs, we can short it. You can decide to put your stop at the high of the week. You could decide the 50% of the week. You could decide all the way up here. I personally wouldn't go that far because they really should just start going pretty quickly, especially if you have the simultaneous break, right? It's like if the whole market reverses on a dime, why would you widen your stop? That should just go, right? So we want to just go high of the week, ideally. And until that reverses, stay in. So like this would be the trade right now. Now, as far as how we guarantee a profit, we say and we preach use break-even stops, but people don't understand what we mean by that because it's a little different than what most people say. So break-even stops, yes, it could be like, okay, I bought it or sold it here. My stop is here. But if it comes back to where you got it, you're out then. And then it might keep going, which is the thing people complain about. So what we want to do is this. Let's say we take it. Oops. Let's say we take it like this. Until that reverses, you can leave your stop wider if you want, but you can move it even. But until that reverses, we don't want to get out. So we can defend it, break even if you'd like. But we don't want to get out. So we just want to hold it till it reverses. With this simultaneous break specifically, the evidence for your trade to work out is extremely high. So like we'd already shown you, when this trade broke, you had everything going down. That's a short every day of the week. That's always a short. So you should just hold it until it reverses when you have high evidence. And that doesn't mean put your stop up here. It means until this gets a higher high, you're in. Okay. Now, let's say you're trading during the week. We will see this weekly broke here on Monday. And we'll say you didn't trade that. Then we have this 2-2 reversal here. We can short it. And we have that simultaneous weekly break going. And this was a simultaneous 60 break. We can short it and then hold until reversal against. So this would be the trade, for example. stop at the highs. You can do it slightly higher if you want, but risking $1 and it ran about 10. Now, you can either decide, I'm going to put my stop even, which is more likely to stop you out. And then you could target the much bigger broadening formation. Or, and this is what we highly suggest doing, you do this. Instead of putting it even to where you got it and not reducing your position, you'd reduce your position by half. So for example, let's say you sold, and we're just going to round the numbers to make it simple here. Let's say you got us a little late, 420 or 524 you sold short. Then we'll say that you covered at 514. You got a terrible cover. You're a little late to it. If you had 100 shares short, you would have made sorry about this. You would have made, I believe it's $10. So you make $10. That means you made 1,000, right? So your open P&L and your closed P&L will look like this. I'm just going to use this over here to make it a little bit easier to type into. All right. So your open P&L is $1,000. Your closed P&L is $0. Your cost basis, or where you have your position from, is 524. That's where you shorted it. So we can either decide to put our stop at our cost basis, 524, plus a penny to pay for commissions if you have that. Or when this reversal occurs, we can decide to reduce position. If we reduce position by, let's say 50%, which would be 50 shares, we'll get that in here. We now have 50 shares left, short. We have an open P&L of $500. We have a closed P&L of $500. We have a cost basis that is now 514. And this right here is what we are really needing to focus on. Your cost basis decreases when you reduce your position. Or in this case, it would actually be 534. So in this case, it goes up $10 if you reduce your position by half. Why does that happen? Well, it's because of this. Let's say this position comes back to 524. You still have shares, 50 shares. Your open P&L, since it's back at where you initially got short at 524, your open P&L is $0.00, nothing. Your closed P&L is still $500. So your cost basis is still $10 above where you got the initial short. So when we go and look at this, this is how it would work. You would take your short position, you would cover it about $10 lower. Your cost basis would look something like this. Take this little ruler here. This is what your trade looks like. If you put your stop right here at your cost basis, this is how it looks. So you're in and you can have your stop here. And now you can ride it out, right? And then what else can you do? Well, you have 20 points to work with. So what if you want to take another short right in here? Okay, I'm in. Well, Alex, I just got a reversal against, I'm going to cover. So you just made another $2. If you already had this nice P&L right here, right? You could risk $500 on this trade, right? Put your stop here, risk 500. You're risking their money that you took from the market. So if it moves $1, you could make, let's say you had 500 shares, you can make $500 just in this little move. Now, if we go in there then, once you reduce this by half, the cost basis on this new position, if we just treat it as a separate trade, it would be here. So you reduce that by half, now you have a trade like this. So you can see we can create position, take their money, reduce, and now we can risk their money to let it go. Risk their money to let it go. And now you can start doing wacky, crazy stuff if you want. You'd be like, all right, well, here's my gap up. I'm just going to hit it right when it goes red. And we have this nice tight stop. I'm going to risk 50 cents. If that works, maybe I can make a lot more. Like maybe I can hold this down in here. Oh, it reversed against me a little bit. I don't care, right? If it stops me out of this, I take the profit on the rest of the position, whatever, right? Or you can, choose to reduce. You say, okay, well, I made another 14 bucks. Cool. Break even my stop. My cost basis goes back up here on this position too. And you can do this wacky stuff where you can have a ton of money in this trade. So what we want to do is exactly as I've shown you here, by reducing position to increase your cost basis above where you got it. If you're short, below where you got it, if you're long. And then you can hold and you can put your stops either at your break even, or you can use the continuity levels. So for example, if you're going to be short this week, the week better be red. So this initial short trade you took in here, put your stop here. So now your stop looks like this. And it's actually like your stop out here, you'd be stopping out for a profit, right? So you stop out for a nice gain still. Which means if it looks like this now and you have the stop here, guaranteed profit, you can start using their money to make even more. Because once it's down in here, the 2-2 reversal, boom, make money, reduced by half. Inside bar back up. So if you want to play it long, you can, but 2 up, 1 compound inside bar that breaks down. So it's going to be a little difficult, but they bring them all the way in. There's definitely trades you could have in here on the 15, 30, 60s. Now you have more, reduce it by half, and you can just keep doing this. So this is where you want to be. Most traders get in there, make a little bit of money, take it off. Get in there, make a little bit of money, take it off. Get in there, lose all the money they made, and then they're like, oh, the strat doesn't work. It's like, you're not doing it right. So this is like the key to actually having some success. And it applies to options. It applies to futures, especially futures. Let me go to NASDAQ here to show you just today. You go to NASDAQ today. This is probably the last chart we talk about here. NASDAQ today, so we have this big broadening formation, right? Don't trade in the middle. Wait for the nice big one to set up. How do we trade this? Well, here's your 3125 minute signal right here. So your stop goes nice and tight. You could literally have risked, like 2 points on this and would have done pretty well. Maybe it's like 10 points, whatever it is here. 8 points, here it is. Okay, so you make some money. Here's 60 points. So now your stop's even and you can risk their money back through the broadening formation. You can take it from here and go to 60 points below. So you put your stop at the lows of this bar. You say, if this low doesn't get taken out, I'm in. And my trade's going to look like this. And you can see you're not risking your money. You reduced, guaranteed a profit, put your stop here and risk their money. And then here, when this breaks, at the time of this break of this signal, your profit was 146 points. So how many points can you risk on this? Well, if the risk is, 29 points, you could double your position size, right? Then once it goes, boom, up they go, break even this one. Now your cost basis, even if you don't reduce this, your cost basis would be somewhere here. If you just doubled your position size from here to here. And now you're in. And then it reverses right up in here and you reduce it by half. Then it breaks here. You're like, okay, it's definitely going to the highs. I'm going to go from my 3 contract position. I'm going to have put on 10. And I'm just going to risk all the money I made. And if it really, takes those highs out, maybe I have 10 contracts and it moves 100 points. Risk their money, risk their money, risk their money, and just boom, 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 boom. And this could make your whole week if you do this correctly. Most traders are just too scared. They don't trust their analysis to do it. And just so you know, you will see this is what we talk about, the 60-minute rev strat. Inside bar, 2 down hammer. Where's that going to go? It's going to go take out the high of the mother bar. So you can trade it in here to set it up or wait for it to set up, then trade all this range in here with the expectation you have 60 minutes to take out the morning highs. So that is the last thing I wanted to show you. If you have any final questions, we can talk about them now. But that's all I got tonight. The last thing I want to say is I did this because I wanted something I could hand over to the people that are in stat or joining stat, today or into the future. And so that's why I did this. So that being said, at the end of this, if you're asking then, it's like, how do we use or leverage stat trading? What we do is we track rotation. So we do all the rotation tracking for you. And as you can see, so I'm tracking all of this stuff for you. I have my nightly videos with signals and weekend videos, monthly, quarterly, yearly videos I put out. So we do all the signals for you and we find them for you. And then it's up to you to choose, are you going to be a daily guy, weekly guy, 60 guy, monthly guy? What are you going to do? What are your goals? You can talk with us about that and be like, well, my goal is to invest, and we can give you the stuff you're going to need to do that. And so the alerts will only make sense if you understand everything in this video. You have to understand the analysis, continuity, how to draw the broadening formations isn't that important, but just knowing where they would be is. And then from there, it's up to you to manage the trade. We do walk through trades and do that with you. But the biggest thing is if I'm tracking 100 stocks, personally, I don't have all of them. I can't. But it's more so like I have 200 people who are listening to me, and they have more time than I do. A lot of them do, to go and track this many. So I might take a few of them, and there's like 5 other ones that I'm not able to because I'm doing the analysis for you guys. But that's the whole point. I do the analysis. You guys understand the analysis, execute the trade, and I do my best to execute as well. But like that's the way it's set up and structured. And as far as the scanner site's concerned, we're making the scanner site to replace me. So it's going to do it all. It's going to do it better. It's going to be more objective, no emotions, and it's going to be able to alert you to the specific conditions we already know to look for. And that's the goal of the scan site. So again, if you're interested in that, you want to support us to do that, check out learnthestrat.com/learnstrat and join there for the waitlist. And if you really want to get your hands on it, if you join the premium section, you can get your hands on it early. You know, to each their own. I honestly, if I were you, I'd just be like, I'll just wait. I'll let them test it out, and you know, it'll get better as time goes on. But that was the goal of this video. Understand the signals, the stops, the risk management, and then you can start following along with the analysis, either just for free on my Twitter, my nightly videos, or if you're in stat, you can follow along better there. So that's all I've got. If you have questions, we can just take a look here first. Yeah, so as far as the scanner, we will be doing a video on the features, and I'm going to use it in every nightly video. So that's going to be definitely something we do. As far as right now, I haven't done it yet because we're still changing a lot of how it looks and works. To see your stop on the chart, I don't know. You got to go on perplexity.ai and ask it the same question and include your trading platform. What would be a dummy proof strat for new people to the strat? I would say playing simultaneous breaks. If you have to wait a little bit, but when they line up, we know, right? And if you're doing it on a daily basis, you have them more often. But we like those weekly and monthly ones. Those are ones you really make the money on. So simultaneous breaks for sure. And you can do that. You don't have to do the whole market. You can do that between, like, let's say Dow Jones has a hammer day on a Monday night. Go in the Dow Jones, look for hammer days, look for inside days. Play it as a simultaneous break between the Dow Jones and the holdings. You only have to look at 30 stocks then. It's going to be a lot simpler. But simultaneous breaks for sure. Weekly signals. You want to draw the broadening formation on all the time frames, ideally. Because you can be in the middle of a monthly broadening formation doing nothing, but at the bottom of a weekly broadening formation at the same time. When it comes to the really big broadening formations, if you draw the monthly one out and you're at the bottom of it, that means you're at the bottom of the weekly broadening formation and the bottom of the daily one. So they're all at the bottom. So if you get a daily signal and then the weekly sets up, and then the weekly signal and then the monthly signal, and it all cascades into each other. So the really big ones, you want to get those monthly broadening formations drawn out for sure. Even the yearlies, I would say it's pretty important to do. I enter with strat combos, get scared. Go watch the risk management section. There's no reason to be scared. Can you get, yeah, the scanner will be released to the public once it is tested by multiple users. We're going to have about 30 in the initial group of users to test the scanner. And then it's going to be released to the public. So, gosh, I'm getting tired. My eyes are burning a little bit. All right, I'll give you guys like another minute for questions, but I'm going to have to hop off shortly. So we had one question about reversals. So if you enter, like, let's say we enter on this 60-minute reversal, 60-minute NASDAQ. When this completes, you'll see the new 60 opens. It wasn't a reversal, but they took their profit. This is because of what we would call the flip, right? 60 minutes they're buying, new 60 opens, the algorithms were told to sell, hit the bid, and do it right now. So we can manage risk in two ways, either a reversal against us, which I prefer personally, or you can use continuity. In the sense of when we look at this chart, since we're at the top of the broadening formation, I'd prefer to use continuity when this happens. Simply because once it takes this out and goes inside in red, this is a scenario 3 and continuity changed here back through it. Whereas when you have a signal, let me show this, for example. Whereas when you have a bigger broadening formation to trade through, which again, this is why we want really big ones. You see it makes new lows. We have the higher highs in here to draw off of. When this signal breaks and it closes here, I still have targets to go after. So I'm going to let this do its retracement. I'll look for new signals here because I still want to see that taken out. And takes that out, and then I'll wait for it to reverse to get out, or I just get out up in here at the top of the broadening formation. There's nothing wrong with selling at the top of the broadening formation. The biggest thing is if you don't let it run, if you have, let's say, full time frame continuity up in here, you're going to miss out on the biggest gains. Whereas if you're doing this and the week is red, the month is red, there's not much you're going to miss out on, right? It goes in here and then kicks back into full time frame continuity to the downside. So the broadening formation expanding and like taking profit, how do we know if it's going to expand up here? Well, how much continuity do you have? Is it just the 60-day? Do you have the day, week, month, quarter, year? You got everyone buying? If everyone's buying, it's probably just going to blow out of there. But if you have conflict with the week and month, conflict with the day, it's less likely to expand. So we want to hit signals that will end up with full time frame continuity up here, because then you get the boom, boom expansion and you make a lot of money. So if we go to Verizon, here's our 60-minute broadening formation. Draw it how you like. New high, 2-2 reversal, boom, shooter 3-2, new low. 2-2 reversal here. Remember how we talked about position management. Get in, little tight stop, make a little bit of money, 16 cents, right? So you can move your stop down into here, break even after reducing half. Let it try and go. You have another 2-2 reversal in here. Since you already had an open position, you can risk a little more money. Go like this, and you're in. And here's your inside bar add. Put your stop at the low of the bar you enter on, and then you're in. So here's your 3 entries, here, 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 boom. Why does this explode here? Also, why does it come back in on a gap? I guess we'll talk about that shortly. But it explodes because when all those signals were occurring in here, the month was green. The week was 2 down and green. The day was a 3-2-2 reversal to buy it. So every time frame's buying, and then it hits the highs, and these guys are short, it explodes, takes them all out. Then you'll see on the month, this is why it's important to draw these monthly broadening formations out. New highs on the month right here. Although the month is green and you have continuity, that's still something you want to be aware of. So once you've gone into what we call exhaustion risk, you can see the big exhaustion wick up here. That's the first little like wink sign at you that, hey, like this, you got some profit takers coming in. And then there must have been some type of news or something down in here. But this is why it's like, it's nicer to reduce. It's like buy, goes all the way up in here. Now, did you reduce? Did you not? Maybe you didn't, right? You could have taken a loss. You will take losses. So I'm not going to say you're not going to. But you can reduce slightly on this, not fully get out. But let's say you had all these trades. You get this big shooter up at the highs up in here. And you reduce your trades by half. Well, your cost basis now is down here. Your cost basis was somewhere in here. So if you reduced half before the close, expecting maybe a reversal tomorrow off the top of the big daily broadening formation, but you still wanted to hold it, you can do that, and you can say you're still in profit here, up 10% on whatever you risked. But hopefully that makes sense. The broadening formation is more likely to expand when you have full time frame continuity. When you don't, If it hits the high of this and then the week and month are still red, it's going to go all the way to the other side of the range, more than likely. Morning prep. I do it all in the nightly vid, but we scan the gaps in the morning. We go through the futures. So like, let's say in the morning, we open NASDAQ prior to the open. So prior to the open, we would draw out. So this is 9 a.m. open. We would draw out our broadening formations on the futures. And we do that across all the futures. We would say it's at the top. We'd prefer it back down, and that's what it does. And we'd say it made the lows. And then you can see profit taking. Failed to make the highs. Rev strat makes the lows, reversal pivot machine gun, and then we get the trade. So there's maybe some little trades in here, but this is the best one. So we'll draw those out in the morning. Then we'll look at the gap lists to see news, who's gapping, earnings gappers, that type of stuff. And all my other analysis is normally done the night before. The 3-2, it's really good if you can find them. You don't always get them though. I appreciate it. So the 3-2, what it actually is a broadening formation that's expanding. So if you can scan for it and seek that out, because we know when they expand, they explode, right? Let's go to NASDAQ up in here. You can see, we get our broadening formation in here. Get our slight lower lows right here. That's your expansion. Yes, that's something we look for with full time frame continuity. We like that. Now, if you're just playing that, you just have to be aware. If you reclaim it, it might go 3 again, and you're going to get wrecked. So we don't want to go down in here. And this is what a lot of people will do. They're like, okay, I'm going to go like this, or this nice big stop. It's like, no, you're going to go here like this, or you're going to use this signal in here to try and cause that to happen. And then you can, lay it on, do what you want with your risk management, like we've already talked about. So if you're playing 3-2s, it's broadening formation expansion. And the way it works is, and this is the last thing I really want to cover. When a signal occurs, you cause the 3. The 3-2 is the confirming that that signal is going to keep going. So for example, we have a 3 right here. If that seller is going to keep selling, it will get out of this and it will not come back. It's going to take the lows out and it will not come back. You can see it hasn't yet, right? So when we take a signal reversal, we want to see it reverse, not reverse against us. We want to see it stay out, because what we'll see then is this. For example, new lows and new highs. These 3 bars are a 3 to this. So this 2-2 reversal, we buy it, right? Goes up into here. These are outside of that. When it ticks up and goes red, we don't know. It might be an outside bar to the downside. It might just be profit taking. Then it goes 2 up again, and you can see now it's getting out, or trying to get out of this broadening formation. Once it closes out, now it acts as support and it expands. But you can see it needs to stay out of that. And then you'll see 3, then right here it expands back through and just takes a lot of guys out. So when you're playing with 3s, you have to know that. So like if we go to AT&T, there's like a really big trade we took. We seek out the 3-2s. Here's your monthly 3-2. Above that, we had all month, right? Hold it all month. It goes red right here. You just get out. Like here's the trade, 10%. We use a signal to make that happen though. If we look left, you'll see 3, 2, and then it stays 2, 2, access support, 2, 2, 2, 2, 2, 2, 2. And then another 3 and does the same thing. So the market's always going to go reversal, cause a scenario 3, and then expand it. Bigger move is going to be the 3-2. So the reversals cause the 3, and then if it keeps going, that is the expansion of it. And that's what we're looking for. Gaps over your trigger depends on the trader. If I'm really confident in the setup, I'll take it. And confidence, again, just comes from simultaneous breaks and continuity and signals. The next strat boot camp, honestly, I'm not sure. It's like, I want to do another one. We've been busy with the scanner, and that's been our main focus. So I'm not sure. We were planning one to start the year, but then we had this huge dissolution stuff going on, and obviously we got a new developer, we have a new scanner going, and all that fun stuff. So that's been like the main thing that's taken up a lot of time. What combos are best? Trade 2 down in green, 2 up in red, 2 reversals. Or hammers and shooters. Just trade 2 reversals. Those are really good. All right. Well, I know we could probably talk about this stuff all night, but I'm going to end it here. So hope you guys enjoyed. I'll see you guys in the next. And if you're with me in Stat Premium, I don't think I'm putting a nightly video out tonight. I think we're going to wake up and I'm just going to try and get back in tune with what's going on. It's really like a lot of continuation stuff. So we'll do some scanning in the morning, just inside days, see what they got there. But that's going to be the gist of it. Obviously, silver and gold, that's where we're going to want to be in the morning. So we'll look at that for longs. And then on the rest of the short side, we'll see what sets up. But that's all I've got. So have a good rest of your night. And I'll see you guys in the morning if you're in stat. If you're not, check out stratalerts.com and maybe you'd like to join. Adios. I'll see you guys then.